our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our target.
33 million people have been affected by this flooding in the monsoon.
Disruption is the whole point of a strike.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Very supportive of the idea of an oil price cap in general for Russian oil. We are working on amending the sanctions package that is required for this new proposal, and we know that we have to be fast on that one, and of course sanctions always need unanimity.
Ursula von der Leyen there, the European Commission President, live from London. This is Bloomberg Surveillance. Your equity market healing just a little bit, but still down, negative lower by 0.75% on the S&P 500. Yields higher by a couple of basis points on a 10-year, 346.89. Euro dollar negative 0.2% and 99.80. A couple of things to pick out. The 2-year, the front end of the Treasury curve, through 390. Earlier on this morning. I'm getting used to saying it, Lisa.
I know.
Getting used to saying sterling at 113, the 2-year at 390.
So yesterday, Tom kept saying, when do we start playing the 4% 2-year game? Is it going to be for 390? And we're here. And this was one day. Yesterday, you were like, we're not there yet. Today, it's, we're there.
We're playing 4% Fed funds over at Deutsche Bank.
Yeah.
We're going to give you more data today, as we always do, but particularly I want to frame again 200 business days of the year. This is one of the 5 days. It's truly ginormous. And I want to mention, John, what hasn't moved, which is yen hasn't moved. It's locked out of fear that they may actually do something about their busted auction
policy.
They
have to do something about that yield curve control story.
But, I'd extrapolate out yen ought to be 145.46. It's not. It's a 143 level just because of the effect of the
You think we're getting to that point where it starts to bite?
Yeah, I think, okay. I do. I think on this Odd Friday, we welcome all of you worldwide, and of course here in London, on a most somber week, and we move to the funeral of the Queen on Monday as well. Right now on international relations on the Shanghai Five, Tina Fordham joins us, founder geopolitical strategist of Fordham Global Foresight, and this could be a 1-hour conversation. Tina, I'm going to distill it into the Shanghai Five, and then there's the Moscow One. How lonely is Vladimir Putin into this weekend?
It's been awkward for him. Right. I mean, I think the image that captured it for me were the leaders of the Shanghai Cooperation Agreement standing, and Putin standing a little bit on his tiptoes.
I do that all the time. I mean, I can say
well, this is the leader who took his country into a special invasion, massively miscalculated, and is now starting to feel not only blowback and setbacks on the battlefield, but almost incomprehensibly for Putin, who's been in power for so long now, calls for his resignation. Usually when a leader goes on a foreign trip, it's it's a photo opportunity, it's an opportunity to distract and deflect and take some nice photos. And Putin ends up looking a bit apologetic. Russia ends up feeling like a kind of a vassal state to China.
I sensed from the serious tone you're taking, you think this is more than just a diplomatic dance. Can you think of the immediate policy implications from something like this?
So this is the kind of thing that is important for market participants, but not a game changer, right? It's diplomatic mood music. We're in a period, an inflection period, right, whereby there is a rebalancing. If you are Turkey, certainly if you are China, but also other countries that weren't represented at the Shanghai Cooperation Agreement, like India, Saudi, South Africa, Brazil, etc., you're watching to see what China does with Russia, how Russia fares in terms of the costs that are imposed for this conflict, because any kind of a sense of a new revival of the old Cold War non-aligned movement is looking pretty bad now that Russia has taken such a pasting. Yeah.
Although there is a sense that Vladimir Putin has been backed into a corner, and what's the consequence going to be with the whole Ukrainian conflict? Will he go harder in other areas? What does he do to save face if he's willing to stand on his tippy toes? The image that you basically put. What's the policy implication of that? What are the potential ramifications from his position currently?
Well, this idea of a kind of an authoritarian leader with nuclear weapons being backed into a corner is a very concerning scenario. When we look at Putin's past behavior, and remember that he's taken Russia into conflicts in Syria, in Georgia, and now in Ukraine, well, twice in Ukraine, he does tend to double down. But most of the military strategists that I talk to don't think that he's likely to use a tactical nuclear weapon. The shorthand is TNW, or maybe a chemical weapon. But we see all of this activity, shelling around Ukraine's nuclear plant, and so the risks of an accident are there.
How concerning is it that there was some sort of meeting of minds about Taiwan from Russia backing China's vision of Taiwan as part of that nation? How does that sort of affect your view of what's likely to play out there?
Well, as we sort of talk about hard power, soft power, signaling, all this international relations terminology that's really in focus here, the attempt is clearly to signal that the powers assembled there support China's one China policy, including Taiwan. Now, behind the scenes, a lot of military intelligence types think that what China has taken away from the way that Russia's fared in the Ukraine conflict is it needs to move sooner rather than later in Taiwan, because that window of opportunity, if indeed there is one, is narrowing.
You are one of the few that truly have a transatlantic understanding and are encyclopedic on the international relations of the United Kingdom. Charles III today will travel to Wales, as he's traveled to others, 1,500 miles, I'm told, just in the last number of days. How united is this United Kingdom under Charles III?
Well, you're here at a fascinating time, right? And I'm a dual U.S.-UK citizen. I've been here for 20 years, and so I have that thing that immigrants have, kind of seeing things in more than one context, which is really helpful. I have to say, though, I'm an analyst and not a kind of a monarchist or an anti or anything else. Mm-hmm. And I look at this as through my U.S. political science hat, and I see that the U.K. has something that we don't have in the U.S. right now, where we have low trust in all institutions, from the media to the Supreme Court. Only the military, U.S. military, is trusted. You can, parse the support for the monarchy amongst different age groups, but even a majority of so-called ethnic minorities support the monarchy as an institution. The way I think about it is how this played out during the pandemic, where in the U.S., we had kind of viral videos of people in Costco saying they're not going to wear a mask because it's a violation of human rights. We just didn't have that here.
People just didn't wear masks.
Not exactly true. But what you have
that in the UK as
is
well.
what political scientists call social cohesion, and that's the willingness to follow rules. You've got people queuing for the queue. It's extraordinary.
I sense
and
that
totally
in the UK,
non-American.
it wasn't politicized here in the way it was in the United States. That's my impression of things.
Well, and that's what polarization will do. It's considered more, these are kind of forces of nature almost. Now, there will be changes as a result of this transition of power to King Charles III. No doubt about it, but not abrupt ones.
I wasn't in this strange position because I was in both London and New York during the pandemic. When I was in London, if I saw someone with a mask on, I wasn't like Democrat, and then saw someone without one and thought Republican. What was that about anyway? Here in London, you just chose to wear one or not to wear one without any real political affiliation behind it.
I just asked that because Tina's fronting for us to move over here. Bring the whole show over here.
I think you're trying to push for that one. Tina Fordham of Fordham Global Foresight.
I never looked back.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
You will put a woman on Mars. You will bring forth global cooling. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close. Weekdays on Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
inflation keeps rising, keeps surprising.
The Fed's going to lose its case to keep raising rates, maybe sooner than we think.
We're still leaning towards 75 just because I'm not sure Powell wants to do shock and awe.
I think the bigger issue maybe for the Fed, and they won't talk publicly about it, but it's the strength of the dollar.
If you start to push back against a strong dollar, you're effectively saying the Fed should be hiking rates as aggressively. That is a problem in itself.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Wind and Fire would be a great soundtrack for the price action, don't you think? Just thoroughly depressing.
I think it would be fire
downbeat. Equity futures down 7/10. Live from London this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. TK, equities lower, the dollar stronger, yields higher at the front end. We had a little look at 390 on a 2-year.
A little bit, right. Well, we're at 390 right now. I just looked over at the Bloomberg terminal, and there we are. And what's important here, folks, is out of 200 business days of the year, this is one of the 5 that matter. This is a correlated mess. We could talk about it all through the show. A wonderful guest qualified to talk about the correlations that are going on, John, and almost without fail, everything's linked together.
A correlated mess with a real-world impact and consequences, whether it's mortgage rates at 6%, Lisa, we can talk about that later, or FedEx. Yeah. FedEx comes out and says, sorry, our guidance was wrong, and the stock's down 20% in the pre-market.
So this is the big issue, right? How many more of these do we have to go? And you were saying this earlier. This is Mike Wilson's world. This is what he's been predicting, and this is what a lot of people have been saying. You're just too bearish. Look what they have been doing. But is FedEx the new norm as we take a look at the consequences of some of these rate hikes?
We're experiencing the rate shock. Tom, is the earnings shock up next?
Well, the earnings shock will also be a revenue shock, and this is the soup is the word, and it doesn't really fit here. But the bottom line is, inflation's moving. We don't know. The real economy's moving. We don't know. And so you've got a complete mystery in the last week about what revenue will be that comes down the income statement to any way you want to define earnings and cash flow.
No mystery about this right now. This equity market heading south, lower, down, negative 0.75% on the S&P 500. A little bit better than where we were.
Better than an hour ago.
Where we were earlier. Yields are higher by a couple of basis points on a 10-year. 346.69 on 10s. Euro dollar 99.87. Negative 0.1% there. The dollar fading just a little bit again in the last hour or so. So not as brutal as when we first came into the office. What time was that, Tom?
I got here, on the U.S. clock,
Nice.
6 a.m.
Do you know what he did
5:52.
today at breakfast?
What?
Stormed out of the hotel. Stormed out of the hotel.
Well, let's talk about this. This is the metaphor.
He was upset about the service.
No, but no, I was not. That's not accurate. This is important, and this is a metaphor for all of you in America. It's the same in London. You got 213,000 claims, and you got a restaurant that's supposed to have 6 people there, and they had 2.
I was picking up the pieces. Do you know what they did for him?
What'd they do?
They said, "You're his boss." I said, "Yeah, I know." And they said, "Take some pastries for him and cheer him up." So I brought him some pastries.
Great.
Do you feel happy?
Yeah.
No, he had I can't do it.
No.
For those of you on radio, I'm holding
Danish.
the big tray like the waiters. John brought over the full English. It was great.
Chocolate croissant. Anyway, futures are down 0.8%. Bramo yields are higher by a couple of basis points.
All right, let's do the brief for you. Tom Keene stormed out of breakfast today. Stay tuned for dinner. No, today, day 2 of China's Xi Jinping and Russia's Vladimir Putin meeting. Yesterday, I found this fascinating. Vladimir Putin said that he understands Beijing's concerns and questions about the Ukraine invasion, basically acknowledging that it was controversial, splitting these 2 allies that had made a pledge ahead of the pandemic that promised to increasingly get close ties together. 8:15 a.m. This I am fascinated for. Colombia's finance minister, Jose Antonio Ocampo, is going to be joining Bloomberg Surveillance to talk about the ramifications of the Fed's rate hiking cycle on the rest of the world. How does Colombia respond? How do they raise rates and continue to raise rates at a time when they have to deal with, yes, inflation above 10%, but also the consequences of a strong dollar and threats to their economy? And at 10 a.m., we get a sense of how we feel. University of Michigan Sentiment Survey for September. How do you feel?
I don't know. They're about to ask 600 people on the phone, though. We'll find out.
How do you really feel about this survey?
That is the survey, isn't it?
I mean, so I think this is interesting because will it be a good news story if people feel good? Probably not, because it'll give the Fed that much more ammunition to say, look, things are actually going along and
I don't think they look at these surveys.
They told us they do.
I don't care. I don't think they look. Clarida will say they're driven by math and models. And I don't think they look at the
Clarida is going to speak for himself next week on a Fed show. Look forward to that. Can I tell you, it's so great to have people alongside us. Andrew Sheets, one of them, just dropped by from Morgan Stanley, the chief cross-asset strategist. Andrew, it's good to see you, Mr. Sheets. When can I buy this equity market?
Well, thanks. It's nice to be with you. It's nice to be with you in person. Look, this is an equity market that I think over the next month is still dealing with a real crucible of challenges. We are into the thick of what we think is going to be a disappointing earnings revision lower. That's a key view of my colleague Michael Wilson in the U.S., my colleague Graham Secker here in Europe. I think this is still a period where it's going to be very difficult for the Fed to sound anything other than hawkish, given these upside surprises to inflation. And then on the geopolitical front, right, it's too soon to get anything real developments in terms of changes in China policy, and still a lot of uncertainty into European energy policy heading into winter. So we think it's still too soon, especially with rates rising, especially in the front end, and think investors should stay cautious, and we think that cash will outperform a lot of assets.
There is, at Brown University, a fabulous tradition of differential geometry. Cornell and Brown on the high ground on that. And it all comes down to calculus. Are you frightened by the rates of change right now in the second derivative as well?
Well, I think the biggest change that I think the market is going to have to adjust to is, investors over the last 12 years, which is a quite long period of time, have known mostly rates of 0 or less than 0 on cash.
Well, Nassim Taleb said this out on Twitter yesterday. He said it's like physics without gravity. Are we getting used to gravity again?
I think we're getting used to gravity. I think we're seeing a real large adjustment. So if you think about the S&P 500 having an earnings yield of about 5.9%, and 1 to 5 year corporate bonds having a yield of 4.9%, that is an enormous convergence in cross-asset yields. And that's a shift we haven't seen for 12 years. So I think that's an adjustment that is truly different, and that the market's going to have to, make some adjustments for.
There's a difference between more downside in risk assets and something breaking, and something that becomes a systemic issue that is a fissure and that is rapid. When does something break as we take a look at that pace of change, particularly with the front end rate?
Yeah, so Lisa, I think that's such a great point, because I think ironically here, the fact that stuff is good, i.e. not breaking, means that the Fed can and likely will do more. I think we see banks with very healthy balance sheets. We see consumers and corporates with healthy balance sheets. The low rates of the last 2 years allowed a lot of Americans to refinance into low 30-year fixed-rate mortgages, which means their largest liability, their highest cost, is almost immune from the rate hikes. And so that strength, I think, means that the market is sending the Fed signals you can keep going. We haven't yet hit that point where it's disorderly.
So what is that point? I mean, can they get up to the Deutsche Bank call of 4.9% on a Fed funds rate and still have things be sanguine enough to give them some confidence that they can stay there for a while?
Well, so we don't think rates will get that high, but we do think that the skew is that they will continue to press higher and go for longer. And again, I think the Fed is having a real challenge, right? In hockey terms, they are trying to skate to the puck, and we don't know exactly what the delay between a rate hike today and an impact on the economy is going to be. And so this is a real uncertainty. I think the market was hopeful that we would get some relief, that inflation would start heading in the right direction, and that would buy the Fed some time. But I think it's quite clear with that sticky core inflation, they just cannot pivot yet, and then the skew is towards tighter policy.
Was that the anti-Gretzky? Is that what that was? Do you like that? You're proud of me. You're so proud.
I'm going to tear up here.
I know.
Get the spelling right on that banner. I mean, I saw Gretzky actually do this as an absolute.
I knew that would get you going.
Where he was playing the Buffalo Sabres in Perot, and Gretzky did exactly what you said. Jerome Powell is no Wayne Gretzky, is he?
Well, I do think what you're dealing with is, if you ask a lot of economists, right, there's not an agreement on what that delay between a rate hike today is on the economy. And then I think there's still very divergent camps, theoretically, right? I think there's a camp, and we heard this last year, the Fed can never hike very much because there's so much debt in the economy, they'll never hike more than 1 or 2%. Versus, well, actually, maybe companies and households have termed out so much debt at super low rates that the sensitivity is lower. And I think this is a real question that you kind of don't really know until it makes contact with the economy.
So Andrew, we came out of the last crisis in 08, 09, and you all remember the projections for high yields. Every single year, high yields, never materialized, yields went lower. Do you sense it's that kind of story in reverse, that we haven't quite fully capitulated on this view of a low interest rate world, that we just seem to think that this is an anomaly and we're going back to where we were before?
I think there's still some of that, and I think the real rate is a very interesting debate where real rates are still quite low. In the U.S., in the Eurozone, in the U.K., they have not yet gone back to kind of just the pre-GFC level, let alone kind of the higher levels we saw in the 90s. So I think there's still room for the market to readjust, especially as you see a healthy household, healthy corporate balance sheets, more capital expenditure that again could point to kind of higher, somewhat higher, neutral levels of interest.
I put out that Deutsche Bank call from Matt Lazzetti, 5% Fed funds next year. The amount of pushback I got on that call, just because people wonder whether we can actually live, Lisa, and you've spoken to this a few times, in a 5% interest rate world anymore.
Yeah, and I think that Andrew Sheets' point, saying that basically people have termed it out, and the fact that they are coping with it gives this uncertainty of maybe we have gotten less rate sensitive and allows the Fed to go further, is really underpinning the reality of what people are pricing in.
You know how you try and get me to explain football to people who don't know football? Can you explain Gretzky
Why are you
to
looking
everyone?
at me?
Can you explain Gretzky to everyone?
No, this is, I'm going to tear up
to where
here,
you
folks,
think the puck
because
is going to be.
Everybody
Here's
knows.
a
I mean, everybody knows I know less about English football than
What
Guy
do I know
Johnson.
about ice hockey?
But you're dazzling me. How do you know that Gretzky skated to where the puck wasn't?
Because his daughter married a very, very good golfer. So I sort of reverse engineered it from golf through his wife and back into ice hockey. That's how I did it. Does that work for you?
I have a lot of questions.
Does that work for you? So sort of reversed engineered it from golf to ice hockey, and then learn about that famous quote. Tom, it takes a lot of work. Andrew Sheets of Morgan Stanley. Andrew, thank you. It's good to see you. Equity futures down 0.8%.
Gretzky was data dependent.
At the corner of my eye, Guy Johnson just turned up behind the camera. We're going to catch up with Guy on a pound sterling that hit the weakest level since 1985. The strikes are going to be back in October on the railway.
Big deal.
And we need to talk about, the 30th anniversary of Black Wednesday.
Black Wednesday, 1992, and it really is a poignant moment considering where sterling is.
Bloomberg's Guy Johnson, a few minutes away, live from London. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The economy in China showed signs of recovery last month. Industrial production, retail sales, and fixed asset investment all grew faster than expected. Meanwhile, the urban jobless rate fell. Beijing had rolled out stimulus measures to counter a slowdown. Still, a property market slump and COVID lockdowns are weighing on the outlook. In Germany, the government has begun what may be a series of historic takeovers to try to avert a collapse of the energy industry. Regulators are taking control of Russian oil major Rosneft's German oil refineries. Now, Germany's also nearing a decision to take over Uniper and two other larger gas importers. The White House is calling on Republican governors' efforts to ship migrants out of the state cruel and shameful. Florida's Ron DeSantis flew dozens of migrants to Martha's Vineyard off Massachusetts. Greg Abbott of Texas sent 2 buses to Washington near Vice President Kamala Harris's home. Republicans say Democrat cities should help handle the results of President Biden's immigration policies. It's a potentially worrying sign for the global economy. FedEx has withdrawn its earnings forecast due to worsening business conditions. The package delivery giant pointed to weakness in Asia and challenges in Europe. FedEx is taking immediate steps to cut costs, including parking some aircrafts, cutting workers' hours, and closing more than 90 FedEx office locations. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Apple has identified its next big business, bringing advertisements to more parts of your iPhone. Today, Apple pushes ads in 3 places: the App Store, Apple News, and the Stocks app. In the News and Stocks apps, Apple shows display advertisements. That means that third-party companies like car dealerships or mortgage lenders can showcase their advertisements just like they can on a website. On the App Store, the situation is different. There, Apple has search ads. This allows developers to buy their way into showing up higher on search results. For instance, an App Store developer can bid for the term car racing or basketball so their apps would surface above competing apps in the list of results. Apple's push into ads is a little ironic, given that its ATT, or App Tracking Transparency Privacy feature, limits the ability for Meta, Snap, and even smaller developers to generate as much revenue as possible from advertising. That's because the feature allows users to choose if they want their data collected and tracked across third-party apps and websites. Still, Apple's hoping to expand its own ads business and is planning to add search ads to its Maps app. Other areas where ads could eventually appear are on Apple Books and Apple Podcasts, along, maybe one day, with an ad-supported tier of Apple TV Plus to compete with new offerings from Netflix and other streaming video providers. I'm Mark Gurman. This is Power On.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg. Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
The Fed has more work to do.
75 basis points seems to be baked in.
How quickly do they get to the terminal rate?
How long do they hold them there?
Chairman Powell's going to have to read the same speech twice.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Is the consumer buoyant?
The dollar is a great place to hide.
The U.S. are going to overdo it.
Investors just have to hold on to their hats.
With special commentary from former Fed Vice Chair Richard Clarida. Bloomberg Surveillance. The Fed Decides. Wednesday on Bloomberg, your global business authority.
I think that if the Fed's going to manage monetary policy on the basis of what was the hottest report in the last 30 days, I think they're going to make a big mistake. I think the Fed's going to lose its case to keep raising rates, maybe sooner than we think.
That's the hope from the equity bulls, that maybe that's the case, and Jim Paulson is not alone. The Luthold Group Chief Investment Strategist, live from London this morning. Good morning. Here's the price action. We're down 8 or 9/10% on the S&P 500. We are in Mike Wilson's world over at Morgan Stanley. He was looking for the corrections to come from earnings scares. And here's one, FedEx. FedEx in the pre-market. I think we can use the word crushed. Getting absolutely crushed in the pre-market, down 20% in early trading. And here's the quote from the CEO. Notice the word speed. Things are moving quickly. We are swiftly addressing these headwinds, but given the speed at which conditions shifted, Tom, first quarter results are below our expectations. That's the FedEx CEO. Are we going to see more quotes like that in the coming weeks?
And the deception here with Jim Paulson is very simply here that the consumer's been acting buoyant. We've seen some good things like claims yesterday the bulls are trotting out. But I would just this is very important, folks. Through the day here on Bloomberg, on radio and TV, this is a different Friday.
They're the kind of quotes that spook people, though, Tom.
Yes,
when you get a CEO that comes out and says, didn't see this a month or so ago, seeing it now and it's happening fast.
Yeah, maybe it's an old FedEx, a new FedEx.
Sure,
whatever.
perhaps,
The fact is, there it is. This is a joy. We rarely get to sit with Guy Johnson. John, I want you to bring
doesn't
Guy
like us.
Johnson. You guys have known each other for years. There's just so much going on here. Away from the funeral on Monday, this is a United Kingdom, John. It's almost like it's reliving the 70s.
We used to have a show together and then you broke it up. I had to come to work with you in New York. Guys, good to see you, buddy.
Sorry.
I know, pre-keen. You're just in between us. We'll talk through you. Guy, 1985.
What's new?
1985.
Can't talk over you.
The 30-year anniversary of Black Wednesday. What a moment for pound sterling going into the Bank of England next week.
The irony is that we are below where we were then. So we're at 90.85 levels, not 92 levels. So the pound is being hit incredibly hard here. The catalyst this morning, retail sales. You look at that sales number. The consumer here hit a brick wall ages ago. But it is now hit the brick wall, gone through it, and is hitting another brick wall. And it is really rough out there. Somebody described this chart as a crocodile. Basically, you've seen the value of goods go up because of the inflation number, but the volume of goods go down. The consumer is being hit hard. That probably makes the Bank of England's decision 50 basis points rather than 75 basis points.
Chris Giles in the FT today scathing about the growth initiative of the Chancellor. What is the labor opportunity here for the Americans, Tory, Republican, Labor, Democrat? What's the labor opportunity to respond to what appears to be a crisis?
The election is a long way away, so in some ways you need to characterise it in that way. The Labour Party certainly will make much of this. What would the Labour Party do differently, I think, is the interesting question that needs to be asked.
Better than my question. Why don't you answer?
Tom. And that is the difficult bit to figure out here. This is a large, in many ways, an external crisis with some really big internal elements to it as well.
We were talking about what happens when the Bank of England comes out and hikes rates by 75 basis points. Does that lead to some support for sterling, or does that really lead to a further leg lower, another brick wall, because it slows growth that's already slowing at a time of a lot of pain?
Yes. It will not cause the currencies to be supported in the way that it would have done in isolation. So given the fact that what's happening with the Fed, given the fact that we're talking about 75, 100 basis points, that's the starting point. The UK economy is clearly in a lot of trouble. And you've got, what I think is interesting here as well is you've got the fiscal and the monetary pulling in two different directions.
Right.
But the UK, next week we're going to have, to Tom's point, the Chancellor laying out a 2.5% growth target. How do we get there? I have no idea. Targets are great, fantastic, lovely. We're going to have a strike that is going to start. You've got a Bank of England rate decision. None of this is particularly positive.
Let's talk about that strike. What is the reason for it? Is there more like it that are coming? What is the goal and some of the tensions that really highlight what the energy situation, what the inflation situation is doing to the broader economy?
Cost of living squeeze, we want more money. That's the kind of the starting point for us. But there is a paying conditions element to it as well. It's a bit like the rail strike that's just been averted in the United States. There is clearly a kind of wage element to it, but there's also we want more sick days. We want to manage how guards are positioned on trains. There's a whole range of other issues. Fundamentally, though, it's a wages issue.
Is there a parallel in that we just had, I believe the statistic is a 24% lift in American railroad compensation over 5 years. Are we going to see that kind of jump in rail labor wages in England?
Unlikely. US rail, hugely profitable. It can distribute some of that money to labour. The UK rail network is a little bit of a mess, if I'm being honest. It is not managed in the way that it should be managed. It's theoretically private, but effectively public, and as a result of which, it is quasi-government, and you're not going to see those kinds of numbers, Tom. You may see significantly higher numbers that you would have seen recently, but you are not going to see those kinds of numbers.
Okay, what's more interesting to you then, if you had to pick one? Is it the budget? Is it a fiscal response to all of this? Or is it the Bank of England next week?
If I had to pick one, I think the biggest struggle now is the Bank of England. I think the near-term currency issue, I'm not sure how concerned they are about the currency, but I think it is a factor.
It must be getting more concerning, guys.
It's imported inflation, isn't it? You think about the energy story, it is imported inflation. We pay for our energy in dollars. and as a result of which that is going to be a factor. It doesn't appear to be that they are concerned about that. If you want to fix this economy, there are massive supply-side reforms that you need to introduce. We need to re-establish the relationship, think about the relationship, develop the relationship with the EU. All of that is what is necessary on the quasi-Kwarteng front.
Yeah.
Are we going to get any of that? Unlikely. Therefore, I'm probably more interested to see how the Bank of England navigate what is an incredibly difficult decision, 50-75. How much damage do you want to do to this economy? How much do you need to slow it down? How much do you need to slow the car down? Because at the moment, it's rattling badly.
Can I throw this in there just in 30 seconds? What do you make of the Big Bang 2.0 here in the City of London?
It's going to have to go a lot further than getting rid of the wage cap.
Sure. I'm wondering what's next.
It sends a signal. I think this is a communication device.
Yeah.
And to your point, a lot needs to come next if we are going to see the City of London becoming more.
What Big Bang is.
There you go.
Yeah.
What does Jamie Dimon and JP Morgan want out of Big Bang 2?
Well, I think in some ways they're getting what they want up front. The wage cap is useful for them in as much as it makes the pay story a lot more flexible.
Looking back to the 1980s and 1970s.
Should I just, the next block, should Guy just move over one chair?
I brought you a pastry and everything, and you're still not happy. In fact, you've got two pastries.
Please, I'm in England. I'm not happy.
Come on, TK. That's unfair.
I thought you loved it here.
Stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
fourth global cooling. Because when you subscribe to Bloomberg, you won't just get news, you will get insight into limitless possibilities. Before you change the world, Bloomberg.
Live from London this morning. Good morning to you. Here's your equity market. We're down 0.8% on the S&P. It improves just a little bit, TK. The dollar move earlier this morning fades. We saw some real powerful dollar strength. That fades just a touch. Euro dollar 99.82, negative 0.2%. Yields higher on a 10-year by a couple of basis points, 346.50. Check out the 2-year, not just on the session, but over the last 5 years. This chart is a deep, deep valley.
Great chart.
Crushed, cratering into the pandemic, and then yields coming out of it absolutely surging through 350, which was the high back in June, through 360, through 370, through 380, and briefly this morning, for a heartbeat, a moment, Lisa, through 390.
You were saying this yesterday. We've seen such a huge reset in the 2-year yield, and yet we have not seen the commensurate lows that we saw back in June. On equities, why not? What is the distinction between now and then that people are seeing? And I think that that's a question that we should all keep asking.
So we're more than 6% off the lows of June, even though 2-year yields are, what, 40 basis points or so, more than 40 basis points off the highs back in June. Not for me to make a market call. Michael Harnett of Bank of America is doing that for everyone. He's come out and said if you're going to make new highs on yields, he expects to make new lows in stocks. Futures are down, Tom.
And they break down sector to sector and across different kinds of companies. The cash flow generators have done better. But the FedEx number today, bring that up if you can on television. For those of you on radio, all you got to know is negative 20 and the decimal points behind the zero. John, FedEx down 20%.
That's
brutal.
Stunning. Corporate earnings can be frustrating sometimes because you can pick a corporate earnings, a report, maybe a new guide, a cut to guidance, and get it to say whatever you like. When it's FedEx and they talk about things like speed, this is happening really, really quickly, that's going to spook people. And I imagine it's spooking people this morning. It's certainly spooking the people that hold the stock when you're down 20% in the pre-market.
And especially if it's a bellwether type of company that is at such the heart of the nexus of so many different aspects of commerce in the nation, like FedEx, transporting packages from one place to another.
The guy came to set just moments ago, and before he sat down, he said, you need to look at DHL, you need to look at Royal Mail, look at what's happening with the European names as well. That story out of FedEx is spreading into Europe too.
It is. And over to Asia, which we've hardly touched on today, there's some immense challenges there with renminbi solidly through 7 yuan per dollar today. Right now, with your most important brief of the day on fixed income, Subrata Rajappa joins us, head of United States rate strategy at the French bank Societe Generale. Their history of math derivative dynamics is world class. Subrata, thank you for joining us. When you look at the derivative mathematics of what we've seen in the last 2 days or even last 2 weeks, what is the telling story about the rates of change in fixed income?
It's stunning. I mean, we were looking at, if you look at a chart, and I think John was showing the chart earlier of the 2-year, we've gone somewhere between 20 basis points last year this time to close to 4% right now. So the rate of change has been just absolutely stunning. To me, what I'm looking at is the message that you're getting from the bond market, which is, to take a page from, I think Facebook's, motto. It's like move fast and break things. That's kind of what the Fed is about to do, which is if they do go along the path that the market has laid out, they're going to have to break things ultimately, and that's what the curve is really suggesting to us.
I got 8 ways to go here. I'm going to go pro on you right now, Subhadra, and that's of all the different spreads, there's that one across all of the yield curve. The 2-year, you go to 3 months, but let's take the 2-year to the former benchmark 30-year bond. It is at a place we literally haven't seen almost in a lifetime, 2000. What is the importance of the level of inversion of the 230 spread?
Absolutely. The 530s, the 230 spread is really at levels we haven't seen in 2 decades. So to me, what the message there is that the market ultimately, if you look at 10 years and beyond, is looking at the potential for a meaningful slowdown in growth and, perhaps a hard landing, especially if the Fed hikes rates as aggressively as what's priced in the market. You're looking at a terminal Fed funds rate right now around 4.5%. I mean, that level was at 4% or below just before the CPI print this week. So the move and the repricing higher of the terminal Fed funds rate has been quite dramatic in a very short amount of time.
Yeah.
So that would mean that there's a potential, much higher potential for a hard landing.
Lisa, I'm going to tear up here. What a control room we have. Qantas and the crew, they throw up a 230 spread chart. No one else in financial media does that.
Can you stop referring to our Australian producer as an airline?
I mean, to see the 230 inverted live on television. For those of you on radio, it's just an act of God. It's just wonderful.
What am I, BA? You know,
Definitely. No, he rejected BA a little bit ago. No, Subhadra, let's get back to the bond market. I think that's a safer place for us to sit on. Maybe, although maybe not. The question is, where do we stop, right? And where do we stop not only with 2s, but also with 10s, given that people are wondering, are we going to break something? And what does the post-breakage look like? Are we still looking at a higher inflation rate, at a higher real interest rate in an era where we're not talking about zero yields anymore?
Yeah, no, I think that really at this, next meeting, given how dramatically yields have risen, I'd be looking to hear from Chair Powell on what they think their policy path is going to be. And in my view, at least, I feel like the market has gotten a little bit ahead of itself, and Powell might have to thread the needle and try to sort of talk the market away from the ledge, if you will. Because, yes, they do want to front-load rate hikes. Yes, they do want to get to 4% in a rush, but I think that they're going to take a much more measured approach beyond 4%. To make sure that they're not breaking things as they're raising rates. So it's going to be a balancing act between what's happening on the employment front. You spoke about FedEx earlier. They'll be looking at a variety of metrics to see what the impact of higher interest rates are on the broader economy. They know that monetary policy acts with lags. So they're going to have to figure out what that lag is and how to act now so that the monetary policy transmission is effective and doesn't break things over the longer run.
Subhadra, does that mean that you're in there buying 2-year bonds?
Buying 2-year bonds, not necessarily. I mean, I think the Fed is not going to be, buying bonds anytime soon.
I'm saying, sorry, excuse me, Subhadra.
Oh.
I'm just wondering whether it's a good opportunity, whether we basically have seen a peak. If you're going to expect the Fed to push back and give the market a little bit of assurance that perhaps they've gotten ahead of themselves, does this mean there's an opportunity in short-term debt?
There might be. The question is whether you want to enter into that trade now, perhaps leg in if you start getting closer to 4% and 2s. I mean, yields start looking very, very attractive. I think you're going to see perhaps a little bit of a tactical steepening between, say, the 3-year and the 10-year part of the curve. I'm still afraid to touch the 2-year part of the curve because it's pegged to Fed expectations and has the potential to move higher.
Right.
But I would say tactically positioned for, say, a 3 or 10-year steepening makes sense to me, at least over the short term.
All right. So, Brad, it's away from your remit, but I'm going there. It's a Friday. No one's listening or watching. What do you do with a 60-40 allocation in bonds? I mean, come on. In this world with these rates of change, I look at the Bloomberg Total Return Index, and 60-40 is getting absolutely crushed.
Absolutely. I think that, all assets are very correlated right now. You're seeing, bonds sell off, equity sell off, the dollar continue to tighten. At some point, when you've seen a significant move in risky assets, the best place you want to be is going to be in bonds because yields are looking very, very attractive across the curve. Even in the long end, even though yields haven't risen as much as they've done in the very front end, you'd still see pretty consistent demand from asset liability managers and pension funds for the very long end. So I think that sort of trade is here to stay, and that's going to keep long end yields, somewhat, pegged. And, it makes sense because if you're looking at a much longer term horizon, you probably want to be long bonds, especially at a time when equities are performing very poorly.
Subhadra, we've got to leave it there. Thank you. Subhadra Japa there of SocGen on the latest in this bond market. The game changer here, guys, and you know it, it's 390 on a 2-year. When we spoke to Oksana Aronoff earlier this week over at JP Morgan Asset Management, how big was her cash allocation in her portfolio?
70% liquidity.
70% liquidity. 390. The message she's basically saying is, I'll take 390 on 2s. I'm not willing to take the duration risk of 350 on 10s.
Right.
Because at the moment, given everyone's saying, yes, and Subhadra's point, there will be people that come in and buy at 350, but I would be nervous too. 7 weeks of consecutive gains on a 10-year yield when everyone was lining up to say we've seen the high. and they thought we'd seen this peak hawkishness, this peak inflation story, and then core month-over-month inflation accelerates again. It makes people nervous.
But here's the interesting tension in the bond market. You're getting yield. You haven't gotten yield for so long, and that's the reason why the likes of Oaktree are seeing equity-like potentials in credit. That's why you're seeing Jeff Gundlach come out and say the same thing.
Got a bearish growl from the other side of me.
I don't know, rhinoceros bear. I mean, honestly, I wonder whether other people are saying that too. If you actually can get yield, if you sit on it, you actually get those returns.
If you sit on it. Yeah, this is so important, and it's so much of what we do, John, at Bloomberg and surveillance is fancy pro-bond talk. Individuals listening and watching who are just looking at price of an individual bond, pick the bond.
But you said it, Tom, hammered.
If it's a Greg's 10-year bond on sausage here and whatever it is, the answer is it's price down, yield up. And you mentioned earlier the mortgage market in the United States. I got on the Gulf Stream to come over here, and I wasn't looking at a 5.8 or 5.9% mortgage, and now it's 6.2%. That's no different than what somebody's bond statement looks like.
So when are we going to start to see that actually really smash around house prices?
We're there.
You think right now?
We're this weekend. We're there. It's why I was in Knightsbridge yesterday. I'm sorry. You know, I'm just trying to keep up with Pharaoh folks.
This weekend, he's trying to get some price cuts. Is that what you're trying to do? This
Lisa,
weekend,
seriously.
cut the price.
Look, when Euro went down the last time, America bought the island south of Notre Dame, Ile de Cité. I can't remember the name of it. Why is this any different?
Hey, Tom, you're making
Why
a
are we
serious
going to buy
point.
acreage in Knightsbridge?
It's a valid point. In the United States, and this breathes some life back into the conversation we've been having all morning. Matt Lazzetti at Deutsche Bank. I'm going to keep ignoring the Knightsbridge line. Matt Lazzetti at Deutsche Bank talking up 5% interest rates. We're looking at 6% mortgages. And the pushback we get against that, the continual pushback we get against that is, can we live in that world?
The issue is, and the housing market is a perfect example, it is not leveraged to the degree that it was ahead of the 2008 crisis, so you don't see the sudden fissure that you did last time.
Guy Johnson wants me to live out halfway to Manchester or Liverpool, wherever he lives, except the property comes with 24 sheep.
It's towards Surrey.
Oh, I don't know where Surrey is, with the fringe on top.
The property comes,
what am I going to do with 24 sheep?
What was that growl when Lisa was speaking?
I don't buy it for a minute.
Well, no kidding.
I'm sorry. I don't buy it for a minute.
Growled at me.
Live from London. This is Bloomberg.
24 sheep?
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Ukraine, President Volodymyr Zelensky says a mass grave has been found in a city that Russian troops abandoned last week. More information is expected today after a visit by journalists. Meanwhile, President Biden says the U.S. will give Ukraine as much as $600 million in additional weapons and ammunition. The aid will come from existing stockpiles. A retired federal court judge has been named as special master to review all 11,000 documents seized at Donald Trump's Florida home. The special master has until November 30th to complete the review. Meanwhile, the judge in the case has refused a government request to use documents with classified markings in a criminal investigation. Shares of Uber are lower today. The ride-hailing company has shut down internal Slack messaging while it investigates a cybersecurity breach. A hacker claims to have accessed sensitive company data. The number of inbound containers arriving at the busiest U.S. port fell by the most since the early days of the pandemic. Officials at the Port of Los Angeles say imports plunged 17% in August from the previous month, an early sign that consumer demand could be starting to moderate. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
A 1 percentage point rise in unemployment increases pain by 10 times more than a 1 percentage point rise in inflation. You shouldn't trust what the Fed says. They missed it last time. They said it was all about inflation last time, and it wasn't. And unemployment went to 10%.
Danny Blanchard, the former Bank of England Monetary Policy Committee member, and Danny highlighting a big problem. When unemployment starts climbing, how does this central bank convince the general public that that is a price worth paying to get inflation lower? From New York City, from London, for our audience worldwide, this is Bloomberg Surveillance, and here's the price action. We're down 0.8% on the S&P 500. Yields just a touch higher, but that story fades in the last hour. The 10-year back to 345. The 2-year had a little look through 390 and came back down again to 388.19. Yield still higher by a couple of basis points there. Euro dollar, Tom, negative a third of 1%, just a touch of dollar strength. 99.
We haven't even mentioned gold, 1,700
sure.
down to 1,665. I want to make clear, folks, the tape's better in the last hour, but this is one of, say, 5 of 200 days of the business year that are really extraordinary, and pay careful attention through the news flow into the weekend. Could you imagine another FedEx shock on a Friday?
How many more are we going to get? And that's kind of what we're grappling with, Tom.
Yeah.
Is this the beginning of something bigger?
Right now, and this is really important and exceptionally timely, I hate Ben Emmons. He writes beautiful notes. You have to read all of it. It's extremely smart with Medley Global Advisors. And he joins us here as a preview to Richard Clarida joining us on Wednesday for our Fed show, the former vice chairman of the Fed. Ben, you know Richard Clarida's history, up, down, and sideways. Obviously, he's a recent exit from the Fed. He will toe the line. But what would you want to listen for from Dr. Clarida about this Fed and this Fed meeting?
Hi, Tom. Yeah, what I would listen for is that has the tone of the Fed really changed from what we say at Medley is a bullish, hawkish Fed. Bullish on the economy, hawkish on inflation. And is that through that press conference really changing? Because as you've been analyzing the entire morning, rates are getting pretty restrictive here, whether it's mortgage rates or treasury yields. And you do reach a level at some point that there is a breakage, if it isn't already happening, as the FedEx numbers show. So I think you want to know about bullish, hawkish, because price stability matters more than the risk of unemployment at this point. As Chris Waller said a week ago, there's no trade-off for the Fed at this moment between employment and inflation, which emboldens them to go further.
Help us with a guess in the press conference of how Chairman Powell will identify a new x-axis. How far out are we going to go in time as we readjust on Wednesday?
Yeah, I do think they will project out in 2023-24 what they think the terminal rate ultimately will be. And I think that's key for markets to understand. You know, we're calibrating at the moment. Could it be 4.5? Could it be 5? To your colleague Anna Wong, it could be even higher. So that's one thing. The other thing, of course, is that the staff economic projections will skew more towards downside for growth and inflation over time. And is that into the recession territory already or not? So I think those are the edges, Tom, as we enter that meeting and post that meeting, which I think Rich will very much highlight. Like, yes, despite that recession risk in the horizon, this is an emboldened Fed that wants to continue.
Ben, it seems like the asymmetry of risks for the Fed has put inflation at the forefront. The asymmetry of risk is that inflation becomes unmoored and undermines their credibility. Do you think, though, it's gotten more balanced, that the fear that they go too far is now more relevant, especially as the likes of the World Bank says, rates where they are, rates heading as high as they could, the dollar moving as strong as it is going to torpedo the global economy?
Yeah, I think that inflation expectations are moving in the right direction. You know, the New York Fed survey was encouraging, whereby you will have to take note that they also published the inflation uncertainty component too, which is still really high. So we're moving down to the average. And as Powell said, as long as these short-term expectations are moving down, then long-term expectations can stay anchored. Because if they're not, those short-term expectations, then they do have a credibility problem. So it seems to be moving in the right direction, but it's not entirely there yet. So it requires this additional 75, 100, 200 basis points of rate hikes to get the short-term expectations more anchored at 2%.
Do you buy the argument, Ben, that right now this economy is less interest rate sensitive than many people had imagined, even though there is so much more debt than there was the last time that we saw rates at these levels?
No, I don't, because, you know, as you can tell from the housing market, it's clearly where Fed policy is showing up in full force already. We do have to indeed think of debt outstanding. It's substantially larger, so there is this risk of deleveraging if you raise rates to a level that's so restrictive that you're getting a turn of deleveraging by corporations and by households. So no, it's a highly sensitive, highly interest rate sensitive economy.
Ben Emmons of Medley Global Advisors, thank you, sir.
Thank you.
Both bullish and hawkish. And Lisa, I think we started the programme this morning with that very story. Are they being emboldened by a lagging indicator? They're bullish the economy, but ultimately what's inspiring them is a tight labour market and claims back to, what was it yesterday, 213?
Exactly, this idea that there still is resilience, and people question for how long. But I want to just point out something. We had expected quantitative tightening to really accelerate, right, this particular week?
Yeah.
The Fed's balance sheet rose. The amount of assets actually rose.
Would you like to explain to everyone what you do at Thursday at 4:30 Eastern Time?
$8.83 trillion, or, but I mean, this is crazy.
Sure.
Yeah.
And it's meant to be coming in and tightening.
And it went up. I'm
CK,
just saying.
What are you doing? It's very distracting.
It's at 4:30
I'm here with
PM.
Scott Cronert. I mean, come on. Can I get out front of this while you guys are you're gallivanting around?
What, with delivery?
Yeah, exactly.
Okay.
Everybody's starting to publish in this maelstrom. Scott Cronert at Citigroup just puts out a piercing note and says it's time to underweight financials.
Yeah.
This is what we're going to see, folks, this weekend. We're having fun in London in the somber moment here with the Queen, and we'll have our funeral coverage on Monday with all the world leaders getting together. Global Wall Street is writing and thinking as hard as
Adjusting, and Tom, I'm pleased you brought it up, because that was the consensus position in this equity market at the start of the year, was to get long banks because the Fed was going to go on a rate hiking cycle. And here we are with a rate hiking cycle that the consensus didn't foresee at all, because we were talking about 1%, maybe 2% this year. Now we're talking about 3, pushing 4, maybe even 5 into next year.
You're looking at a yield curve that's incredibly inverted. You're looking at deal activity that's fallen off a cliff. You're looking at this concern that FedEx expressed that companies are not going to be spending as much. It is not a recipe for banks to do well.
I can tell you things are turning just a little bit. We were much, much lower this morning on the equity market. We're now down just 0.8%. Yields were a lot higher. The 10-year just rolling over in the last 20 minutes or so, Tom. Now basically unchanged at 344.56.
We pause here now for a momentous moment where someone came up to me and thanked me for my soccer knowledge and coverage here in London.
Did that actually happen?
The olive came out of the martini. Let's do this right now. This guy's exciting. For those of you that don't follow this is a reason to follow John Farrow in English football. This kid at Man City.
No idea.
John, this kid at Man City, to me, is the day Shaquille O'Neal showed up in the NBA.
Erling Haaland, absolutely prolific. He's an old-school goal scorer.
6'10"?
I don't think he's quite 7 foot, but he's an old-school goal scorer. Number 9. We kind of drifted away from that in the last decade or so. Manchester City going back to that. A poacher, Tom, someone who likes to play inside the area but can break from the back as well. He's just awesome.
Did someone actually come up to you and thank you for your soccer?
Oh, yeah.
Happens all the time. Happens all the time.
That's wonderful. That's beautiful.
He said the two of you are
He woke up and stormed out of
He said the two of you are gaslighting me the entire trip. You're gaslighting me.
Watch it.
Should we anticipate that you will have regulations clarifying what the SEC is going to do on cryptocurrencies and related kinds of things in the near future?
It's pretty clear that many of these tokens may be securities. What we've asked the trading platforms, the lending platforms, the other various venues to come in, to work with us, to get registered under the securities laws, because if a platform has 50 or some of them 500 tokens on their platform, probabilities are they're not all non-securities.
Now, there's another issue that has arisen, which is called gamification, which is to say people are making a game out of trying to buy stocks. Are you worried about this phenomenon?
We live in the 2020s in a new digital age where applications on our phones can use massive amount of data and then predict our behavior. What do we do when the digital algorithms are maximizing for the company's revenues rather than our returns? And so we're trying to think that through. It's not just gamification, it's a little bit more than that. It's whether there's a conflict between the app and our investment returns.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our target.
33 million people have been affected by this flooding in the monsoon.
Disruption is the whole point of a strike.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close. Weekdays on Bloomberg.
The U.S. inflation number was horrific.
The valuation story still suggests that there is more downside unless a retreat in inflation happens much more quickly.
The worst outcome, I believe, it would be if we see inflation remain elevated to the medium to long term.
If you had any hope that Chinese demand was going to help the growth story right now, you can forget about that.
If we stop the tightening of interest rates, I think the market would probably come out of that okay.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The guidance cuts just getting started. Live from London for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures down 0.8%. At the epicenter of this move this morning, a little bit earlier, yields higher. That fades. TK, FedEx, front and center.
FedEx down 20%, really a bellwether here. And for those international, it's a hugely important stock that America follows. Global Wall Street in America follows every step of the way. John, what I would notice today with NASDAQ down a full 1%, trend continues, and you wonder where we are at 2 p.m., 3 p.m. this afternoon in New York. How do you stay long into this weekend?
FedEx down 20% in the pre-market. That's just a wow move for a lot of people. And Bramo, we asked the question, let's do it again. Is this the beginning of a sequence of events like this one that we'll see deeper into the year?
It's the pace of which they saw the change in the outlook. And I think you pointed this out earlier, which was really a good point. The speed, and the speed of which we're actually repricing some of the hawkishness of the Fed at the same time that companies might be rethinking how robust the economy is, really is a toxic recipe, and brings up Mike Wilson. The bulls, though, see the idea of, okay, that weakness will let the Fed take their foot off the gas. Is that really possible?
You almost laughed then, didn't you? The toxic brew. Throw in high yield as well.
I don't laugh.
Jim Paulson in the opening. John, importantly, Jim Paulson in the opening and others pushing. Michelle Meyer, I thought was optimistic at MasterCard. They're pushing against some of this toxic brew.
They're asking the question as to whether this Fed can keep on hiking in the way it is, the way that people are expecting them to. And to really frame that, and we've mentioned it a few times, we should do it again, Matt Lazzetti at Deutsche Bank, if you're just tuning in, he's now looking for something close to 5%. I think it was 4.9 on Fed funds.
He's catching up with Anna Wong of Bloomberg.
The amount of doubt out there, Tom, on this Fed's ability to actually get there, Lisa, that's where the debate is. Can we live in a 5% Fed funds world?
And there's also this concern about a lack of understanding of the lag time that these rate hikes will take to actually hit the economy. Because if we don't know what the actual effect is, and the Fed keeps hiking, is there suddenly a 1-2 punch where people actually see the weakness and you see the ramifications of those higher policies all at once?
And yet they're emboldened by a lagging indicator on top of that as well, the labour market. I mean, Tom, this raises the question, and Mark Urbana said it earlier this week on this programme from Bank of America, the Fed getting lulled into overdoing it. How many times have we heard that?
It's an interest rate financialization analysis. When does the Fed look at the real economy? That's the heart of the matter.
6% mortgage rates, are we there now?
I think 6.2%. 30-year, can you imagine 6.5% based on the trend we're in?
But if we don't get prices to come down a little bit for houses, then the affordability crisis gets even worse also. On the margins, they're starting to, but the goal isn't this the point, that they want to bring the froth off this market because it had gotten too hot?
Let's digress quickly here because we've got an important guest. Sterling goes to 110. All of America buys Knightbridge, except everybody's demand there. How do prices go down in Knightbridge? They don't.
Well, that's everyone else's problem, isn't it? It's our currency, your problem. And that's maybe what the Fed is communicating right now. I think that was absolutely tremendous. I think the big conversation we're ultimately having, whether it's FedEx, whether it's the labour market, mortgages, house prices, all of the above, what price do we have to pay for this Federal Reserve to get inflation lower? And I still don't think we fully realise the price we have to pay for that. They've got these kind of optimistic, aspirational forecasts of unemployment slowly creeping higher into the high 3s and maybe breaching 4. Are we going to be talking about something close to 5%? And really, that's what Matt Lazzetti and co. are thinking about.
We just don't know. And a lot of this has to do about whether some of these factors cooperate, and the CPI report did not cooperate, and now we have a 2-year yield bumping up against the 4% level.
Equities right now down 0.9% on the S&P 500. Alongside us, I'm pleased to say, Dan Morris is going to join us, the BNP Paribas Asset Management Chief Market Strategist. Dan, that equity market down about 37. Let's start here where we started with many people this morning. When do you buy this? When do you feel confident about buying this?
Well, we need to see the second shoe dropping. The one we've had so far is the correction of valuations because of policy rates going up, real rates going up, P's on the NASDAQ going from 33 to 20. So all well and good because we need to get to a reasonable level. But we know by looking at consensus earnings estimates, those haven't adjusted yet. And if we talk about this recession scenario for next year, that's not particularly compatible with the 8-9% year-on-year earnings growth forecast that you see in the consensus.
Yesterday or the day before, just for a whisper, I got the feel of the 70s. I was a bit younger there. Bob Seger was killing it. Okay, great. You write about it in your research note. You say the wage price spiral is here.
Yeah.
Identify that.
Well, the headlines yesterday were, strike averted with the railroad workers in the U.S., which, of course, very good news, but it was worth noting that part of that deal, assuming it's approved, was a 14.1% increase in wages now. And, of course, we've only had 8% year-on-year inflation, so they're making up, so all well and good. But if you're that railroad worker, and good for them, they'll have the salary, but what are you going to do? Well, you're going to spend it, so that's going to push up demand, that's going to push up inflation, and off we go. So, you don't see the same level of unionization across the economy, so it's nice to suggest this is going to happen broadly, but it does highlight the challenge the Fed faces in trying to stop exactly that process.
So do you disagree with Subhadra Rajap of Societe Generale when she said that perhaps the market has gotten a little ahead of itself and the Fed is going to have to push back on how aggressive people are pricing the Fed funds rate?
Oh, gosh. I mean, the market is now ahead of where the Fed was at the last stop lot, but it's kind of closer to where we expected. We always expected it to be between, say, 4 and 4.25, and we're there now. So that's kind of the good news when we think about the threat to equities from the increase in policy rate expectations. We've gotten above 4. We're in kind of the right general area. But now this debate is, how long does it stay there? And the market still has the Fed pivoting spring of next year, the Fed saying no, maybe spring of the following year. Again, that's more what we think is going to happen. So there's still that adjustment that has to take place, and we've seen those aren't particularly pleasant.
Pretty scary world right now. Easily to scare yourself even more if you wanted to. Tom's asked the right question, I think, all week. Where do we hide? Where'd you hide?
Well, I think we need to think about time frame. So what we've seen so far this year is the dollar's been, the one safe haven. And if you look at the supports that you've had for the dollar, they're probably still in place now. Does the dollar continue to appreciate? Not necessarily, but it's reasonable, I think, to see it staying there. If there is good news in this, you're nearly 3.5% on treasuries. And for us, we don't see a big increase from here. So you're at a level on treasuries where if yields are stable, you're getting 3.5% there. Even if equities are weak, at least we're going back to a negative correlation in the price returns for equities and fixed income. And that'd make a lot of multi-asset portfolio managers feel a lot more comfortable.
BNP Paribas really thought about this. You've got yourself, Carl Riccadonna over in America, and others really thinking hard about this. Taleb yesterday, Nassim Taleb, who I adore, out on Twitter saying, we've been doing the math like we don't have gravity in physics. We're getting the gravity back. Maybe we're getting the risk-free rate back. In the Sharpe ratio, does that clear out the zombie companies, the zombie banks, the zombie manufacturing shops, and the others?
What makes it difficult to assess, and this is kind of one of the implications or the consequences of the pandemic. So what we saw with the lockdowns was the response of governments was like nothing we've never seen before. And we're starting to see hints of that, at least in Europe now, with the energy crisis. Governments willing to do much, much more than they would have done in the past. So what that might mean for balance sheets, for longevity of companies that otherwise maybe would have gone bankrupt, I think that's an open question. But then we have to think, well, if they're doing this, where's that money coming from? And we're going to start looking, again, I think, much more at government balance sheets, debt levels, if it's not going on the corporate side.
We start to treat G10 countries like EMs. Is that what you're trying to say but not saying?
Are you
getting closer to saying that?
We're going to. Well, you already see it in EM now. You know, current account deficits. Current account deficits in EM are driving the currencies there. So it is going to become a bigger consideration, a larger consideration in the future.
For the UK right now or in the future?
Well,
feels like
right now to me. Tomorrow.
Feels like right now to me. Dan Morris there, BNP Paribas Asset Management. Very diplomatic, Dan. I won't be. Feels like we're there right now, Tom. Feels like we're there right now.
The analysis suggests that we're not there, but we're tending there rapidly. The analysis of the optionality of institutions is narrowing fast.
Lisa?
I just can't get over that Tom loves Nassim Taleb, and then he calls me the Uber bear.
Oh, well,
I mean, you know, you're the triple leverage.
Nassim and I go way back.
I'm not offering therapy here.
Yeah.
You know, you can speak past me. Does something you want to say?
Honestly, I think that you're going to see a lot more volatility in the FX channels because that is where some of the difference in economic growth trajectories will be expressed. How violent do things get if Japan really, to me, that's the wild card,
Well,
if they are forced to abandon that peg.
To your point, into the weekend and Sunday night in New York, opening in Asia, Japan's front and center.
I would agree.
I mean, I wonder what the Monday is going to look like in Japan.
You're agreeing with each other now.
You did a great job being a therapist.
Can I say that somebody emailed in and they said,
lean back a little.
They said, we don't have Tang in London. And I said, but you've got Tang Pico tea.
Okay.
And it's really good.
So what is this?
This is Tang Pico tea.
And what does that taste like? What's the review?
It's really sort of tepid. I'm on the edge of Ted Lasso.
Have you got a commercial agreement with them yet?
No, I don't.
Okay.
But it's just brown. And,
you should negotiate that. It's brown.
It's Tang Pico
it's tea.
It's like orange Pico, but it's Tang
It's like orange flavoured tea.
Yeah.
Okay, I'm pleased we cleared that up. Everyone was wondering what you're drinking.
Yeah.
Which is usually the case. Futures up 9/10 on the S&P 500. Yields unchanged on a 10-year.
This is an important conversation
3.45.
coming up.
I couldn't agree more, Tom. We're going to catch up with Jose Antonio Ocampo, the Colombia finance minister. We'll do that very shortly. With futures down 0.9% on the S&P and a big warning from FedEx that maybe some guidance cuts are in our future across a range of companies. FedEx in the pre-market is down about 20%. Live from London, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The pound has fallen to its lowest level since 1985. Sterling dropped by as much as 1% to less than $1.14. The latest hit to the currency was data showing British retail sales fell at their sharpest pace in 8 months in August. Since the start of the year, the pound is down about 16% against the dollar. In Germany, the government has begun what may be a series of historic takeovers to try to avert a collapse of the energy industry. Regulators are taking control of Russian oil major Rosneft's German oil refineries. Now, Germany is also nearing a decision to take over Uniper and 2 other large gas importers. China has imposed sanctions on 2 American business executives over the sale of anti-ship and air-to-air missiles to Taiwan. The penalties were being levied on Boeing Defense CEO Ted Colbert and Raytheon CEO Gregory Hayes. Now, the missiles were part of a $1.1 billion U.S. arms sale to Taiwan announced earlier this month. More than 100,000 workers will decide whether there's a new labor agreement with U.S. railroads or a strike. They will vote on the tentative deal reached on Thursday. Now, the agreement increases wages and includes a compromise on sick days. A timetable for the voting hasn't been released. And it's a potentially worrying sign for the global economy. FedEx has withdrawn its earnings forecast due to worsening business conditions. The package delivery giant pointed to weakness in Asia and challenges in Europe. FedEx is taking immediate steps to cut costs, including parking some aircrafts, cutting workers' hours, and closing more than 90 FedEx office locations. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg. Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays. Are on the Fed.
The Fed has more work to do.
75 basis points seems to be baked in.
How quickly do they get to the terminal rate?
How long do they hold them there?
Chairman Powell's going to have to read the same speech twice.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Is the consumer buoyant?
The dollar is a great place to hide.
The U.S. are going to overdo it.
Investors just have to hold on to their hats.
With special commentary from former Fed Vice Chair Richard Clarida. Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
Okay, well, our target now is 109. People are out there talking about parity. Can we dismiss that? No, I don't think we can dismiss it. It's not our target, but, it depends very much on the US dollar. These are still nasty numbers to come. And right now, I think the dollar strength will sustain.
The fact that Jane Foley of Rabobank can't dismiss the prospect of sterling hitting parity tells you a lot about this moment we're in right now with dollar strength. That was Jane Foley of Rabobank just moments ago. Live from London, this is Bloomberg, and here's the price action. We're down about 1% on the S&P 500. Yields were much higher, they fade. Unchanged on a 10-year, 345.53. The dollar stronger. Euro dollar negative 0.4%, 99.61 on euro dollar. I'm going to keep promoting this. Next week, Fed Decides Day. The show's coming together. We'll catch up with Matt Lazzetti of Deutsche Bank. He's looking for 5% Fed funds, something close to that next year. We'll also catch up with Rich Clarida, the former Vice Chair, Tom. And we've got to work out. At the moment, it's our currency, your problem. When does it become our problem?
Exactly, and the historic scale of that is something that Dr. Clarida has worked on as the former Dean of Economics at Columbia University, always affiliated with Columbia University, out of Notre Dame, and of course, most importantly, out of Yale University. Jose Antonio Ocampo joins us now, Minister of Finance and Public Credit for his Columbia. We're thrilled that he could join us this morning. There's so much to talk about, Minister, but I have to go larger. I have to reach back to Stan Fisher in 1998, Do you, through the prism of Colombia economics and foreign exchange, see anything like an international upset that we witnessed in 1998 and frankly before that in 1992?
Well, thank you. I'm delighted to be with you. Let me say on that I don't think the same kind of crisis, the 1998 was very much an emerging market crisis. This is a global crisis, both the slowdown, particularly the inflation, and the increase in the interest rate, which is affecting us very heavily.
Very importantly, sir, I look at the caps, the limitation of price increase. We see it on India and their challenges with rice. Here in the United Kingdom, we see it. And indeed, Colombia and others talk about it. Given a more global economy, the speed of information, the transfer of finance, can caps be effective in 2023?
Well, let me say that the major problem that we're getting from the global economy is the inflation, but particularly the effect it has had on interest rates. So both domestic interest rates in Colombia, as well as the interest rate in global capital markets are very high, and that the major specific effect. Of course, inflation is hard to fight due to the international dimensions of inflation. So for a specific country, it is very tough to fight that inflation, which you can say is a supply inflation rather than demand inflation. Central banks are good at managing demand inflation, but less so in managing supply inflation.
There's a great concern that when the Fed hikes rates by as much as the market is currently pricing in, Minister, that it will create some real problems for the rest of the world. And I wonder, from your Colombia, whether you're taking a look at the dollar market and saying we cannot raise money in that right now at affordable rates. Is that really the situation as you look at your financing needs looking out?
Yes, private capital markets are very expensive for emerging economies today. Including, of course, Colombia. So for the time being, our international financing is coming from multilateral development banks and official institutions. But so far, we have not gone this year into the private capital markets. We hope things normalize somewhat in the near future, and we'll go back to the market. We're expecting to raise about $1.5 billion in the private capital markets next year.
What does it mean for things to stabilize, Minister? Does it mean that the dollar stabilizes? Does it mean that the Fed stops raising rates? Does it mean that inflation stops accelerating?
Well, it really means that the long-term interest rates of the U.S. start to fall. They were falling actually before the recent announcement of the Fed that they would likely increase interest rates again in the next meeting. But before that, they were falling, and also the risk margins for emerging markets were also falling. But the situation has changed again. But we hope at one point when the inflation stabilizes in the United States, the interest rates of the U.S., particularly long-term interest rates, which are the relevant for us, start to fall.
Dr. Ocampo, you have been one of the great voices of Colombia through a time, and the stereotype in America is of true civil unrest in Colombia. You've moved beyond that with a new government and your participation as well. Can you describe the stability in Colombia and what it means for your tourism? So many people have gone to Cartagena and the rest of it. Describe the tourism future for Colombia after decades of real unrest.
Well, let me say that the peace process that took place 5 years ago has been fairly successful in generating peace in several parts of the country. The current government is involved in other negotiations that we hope will be successful, and let's say the return to peace in many parts of the country has generated effectively what you say, actually a boom of tourism. We hope that it will come back when the world economy fully recovers, because tourism in the world is still a bit depressed, let's say, although it's recovering. And in Colombia, we'll hope to have a new boom of tourism.
Minister, I want to ask you about the Colombia economy. What is the outlook for the economy? 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 What is the outlook for the economy
Minister, we appreciate your time today. It's lucky to catch up with you. We're lucky to catch up with you. Jose Antonio Ocampo there. Minister, talking to some of the problems we've got in the world right now. You forget that in EM, they've done a lot of work already on the rate side before the Fed even got started.
Yeah, the rates up in the 8-9% level, raising rates to offset some of the impact from those higher dollar costs. I was really struck by the fact that he said he's going to rely on some of the international agencies for financing rather than tapping the dollar market right now because things are just too expensive.
I know Damian Sassar and his team are working 24/7 on this. Damian does this better than anybody out there, linking foreign exchange into the bond dynamics of emerging markets. But it drives forward, as Lisa mentions, John, this is not a normal IMF meeting coming up here in 4, 5, 6 weeks. I can't even tell you what it's going to be, but it's going to be important conversations for our international audience.
I can tell you we might be there.
We might be there.
We might be there.
If we ever get home.
Coming together. Seth Carpenter
awfully nice here.
might be there from Morgan Stanley too. Are you thinking about staying?
Well,
you're considering staying
this weekend.
Okay. Bramo is converted. She's thinking about staying. New York for life, and now she's all like super hyped up on London.
Fortnum and Mason.
Seriously, loves it. Future's positive, now negative 1%. Bramo sent them there. This is Bloomberg.
When you've had your fill of IPOs, ETFs, and CPI,
tune into the lineup for some NFL, NBA, and MLB.
catch the lineup right here on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
You will put a woman on Mars. You will bring forth global cooling. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Our next guest sees a 75 basis point rate hike from the Fed next week, sees Fed funds peaking just above 4% in the next year, and then rate cuts in 2024. We're going to get to that in just a moment. Equity futures take another leg lower. We're down by a little more than 1 full percentage point on the S&P 500. This happens as the 10-year rolls over. It's not higher. It's basically unchanged on a 10-year, 344.56. Dollar stronger, euro dollar negative 0.4%, 99.62. That dollar strength, Tom, that is sticking through much of this morning.
An important conversation now, and this gets us in preparation for Richard Clarida joining us on Fed Day as well. Clarida is known for DSGE, and all we're going to say is it is dynamic. And as Meghnad Desai, joining us from Delhi the other day on the Queen, stated general equilibrium theory. And in the middle of all that is stochastic. And what that means is things are moving rapidly. And Seth Carpenter is chief global economist at Morgan Stanley and knows decidedly it is a stochastic 2022. Seth, what is the process or path to get to calmer times, a calmer economy, and calmer markets?
I think that prospect will require a fair amount of luck. I think the challenge here, especially you started off talking about the Fed, they are feeling their way to how far they have to raise the federal funds rate. They want to be restrictive. They want aggregate demand to slow down a lot so that that underlying inflationary pressure starts to ebb. But what they don't want to do is intentionally cause a recession. And getting to that point, I think, will require a bit of luck.
How do you respond to the idea that the inflation impulse has a certain effect on the public, but the jobless impulse has a much greater effect?
Oh, I think they're both very, very important. Clearly, for people who have lost their jobs, that's just very, very difficult. It crimps their spending a great deal. We don't have in our forecast any meaningful rise in layoffs. In fact, if you look at the last jobs report, that was super strong at over 300,000. So far, that's been okay. The inflationary side of things, though, very much hits the pocketbooks of everyday people. The rise in gas prices that we saw a few months ago was painful. That's starting to come off now. I think the challenge for the Fed then will be, if gas prices come down, do people go back to spending more, or have they been hit hard enough in the pocketbook?
Seth, we spent the whole of summer trying to work out what the threshold would be for a pivot, a pause, maybe even rate cuts next year. You've got rate cuts out in 2024. I just wonder, what is it about 2024 where you think this threshold is going to be breached and the Fed starts cutting?
So I will just own up front, the uncertainty here is huge. Of course. We said for many, many years, lower for longer was what central banks are doing. Now it is higher for longer. And again, I think what the Fed is trying to do is feel their way to where they can rein in the economy without actually causing an outright recession. And that's the reason why they go to what they call restrictive territory. But then not so much that things actually crash and then hang out there as the economy slows down. So that's what we have as our baseline, is you're getting some traction, and then they just wait for things to slow down.
Right. John, I just want to point out, equity futures just moved to new lows for the morning.
Another leg lower?
Yeah, another leg lower.
And that's the story so far, Seth, and the story many people are grappling with for participants in markets at the moment is whether these are sufficiently tight financial conditions for this Fed to achieve its objective. Do you think they are right now sufficiently tight?
Very hard to say. I will say one of the most typically sensitive sectors is housing, and we have seen a very strong rollover there in housing. On the other hand, consumer durable goods spending is actually still holding up to some degree, so it's not clear that things have actually bitten yet. That said, you were talking about equities. My colleague Mike Wilson always points out that this probably needs to be a leg lower in earnings projections, and I think that makes sense. If the economy is going to slow down enough to get inflationary pressures under control, you just have to expect earnings across the board to be lower than they are now, and we're just not there yet.
I like your call for holding it at 4%, though, for almost a year for the Fed funds rate. And I wonder if people are underestimating the pain of holding rates at a level like that rather than just missing the boat, raising too far, and then quickly cutting again, which seems to be the projection in markets.
I think there probably is a bit of underestimation there, but I suspect the even greater underestimation is what happens if hiking rates to 4% isn't enough? What happens if they hike to 4%, wait there for a quarter or two, and the economy just proves to be strong enough that demand is there and inflation doesn't come down? Then the Fed's just going to keep hiking. And I think that point, that there's not really an upside to economic growth right now. It is either things slow down and inflation comes under control, or they don't slow down and the Fed just hikes more until they do slow down.
John and Tom both make fun of me because at 4:30 p.m. on Thursdays, I take a look at the Fed's balance sheet to see where it is and whether it's coming down as they promise quantitative tightening. Over the past week, it actually rose. It became bigger, even though they ostensibly were supposed to be accelerating quantitative tightening. When do we start to feel the effects of this? When does it start to matter for markets?
That's a great question, and you and I can sort of bond on Thursday afternoons. That was a big part of my job at the Fed, was being in charge of the H401 statistical release. Nerd alert. Yeah, the challenge, I think, with getting QT to actually show up on the balance sheet in large part is, some of the way they're settling their mortgage-backed securities holdings on a forward basis, and so it really hasn't shown up. Just give it a couple more months. The treasuries are coming off their balance sheet. Over time, the mortgage-backed securities will prepay and go away, but it does take a long time.
Seth, I look at ADXY as a bundled Pacific Rim thermometer, if you would. I look at Korean won unraveling through the week. Help us into the weekend and into the Asia morning. What is the gamesmanship Morgan Stanley sees? And you've got Robbie Feldman in Tokyo, who's iconic, but what is the gamesmanship you see of the Bank of Japan and the Ministry of Finance into their Monday morning, our Sunday evening? Are we close to action?
That is a great question. So our baseline view is no, not from the Bank of Japan. You have Governor Kuroda in place. His term is up in the first half of next year. He has been committed for so long to being easy with policy to try to get inflation up. Now it is working. Clearly, the yen has gone on a tear, going lower and lower and lower against the dollar. But finally, they're starting to get some traction with inflation.
Seth, very importantly, what do you read and listen to from Robbie Feldman? You have the advantage of Dr. Feldman in Tokyo, who's absolutely iconic on this. What is Robbie's twist on this?
No, Robbie is fantastic, and I think everybody should get the opportunity to read his work. I think the key really is here all about legacy and the amount of time and effort that has been put into this very easy policy to try to get inflation up. Japan has had lost decades, plural now, when it comes to the deflationary spiral, and I think there really is a sense, at least with Governor Kuroda, that it's critical to stay the course to get inflation up.
Seth, can we just wrap things up with FedEx? It's such a big story for everyone this morning. It's arguably contributing to some of the nervousness around the equity market as well. The stock's down almost 21% in the pre-market. We all know this is not a small company. It was something like a $50, $60 billion company. It won't be if we close here a little bit later. Seth, they're talking about speed, that things have slowed down really, really quickly. Is there anything that you look at on your dashboard that would perhaps resonate with what FedEx are experiencing? Can you see anything like this?
Well, I think one of the key points with companies like FedEx in the shipping business is we did see this massive surge in goods spending. Yesterday's retail sales report didn't really make you feel like it has unwound completely yet, but it does seem that at some point we're going to have to see that consumer pullback from as much consumer spending as had been going on physical goods, and that's going to have ripple effects across the economy to retailers, but also to companies that do a lot of shipping.
Seth Carpenter of Morgan Stanley. Seth, thank you, sir.
Thank you, Seth.
It's good to hear from you.
Thank you.
And it speaks, as Seth said, to Mike Wilson's world, and we've mentioned that a few times. Mike Wilson over at Morgan Stanley was looking for that next so-called shoe to drop. Earnings warnings, those kind of things. To see FedEx down 20% and warning about a rapid change in the business environment, can you see any other data point out there? Maybe the regional Fed PMIs that back some of this up, the regional Fed indicators?
It's been messy, though, right? It's been inconsistent, and it goes to this question that we just heard from Seth Carpenter, where if you start to get gasoline prices that are becoming lower, what happens to consumer spending? Do people keep spending? more in other areas? Do they feel lighter, or do they just continue to get a little bit more cautious? And I think that we're not getting a clear sense of that from companies yet either.
The guy talked about how global some of this was as well, Tom. Is that enough to spook you, that FedEx move, 20%?
Oh, yeah. I think you can link a domestic image like FedEx right into the global view. We feel it here certainly in London as well. But I, again, would go to Asia with lockdown. I mean, I believe we can state as a general statement.
Yeah, I think so.
They're still in lockdown, and I'm fascinated to see how the IMF readjusts Asia at their October meetings with the World Economic Outlook. Are they in negative GDP? That would be just a stunning outcome.
Can you think of a two-handle maybe on Chinese GDP growth from that organisation?
I'm not qualified to make that decision other than the vectors.
And there is a question of whether people want to be the ones out front with that, just based on some of the climate. We got some data from China overnight, and it was better than expected. What I thought was interesting was that the Chinese yuan did not strengthen versus the dollar. Quite the opposite. It continued to weaken, even though we saw better than expected data. So either people aren't buying it, or it isn't enough to really make people feel optimistic about growth.
The dollar China still a 7-handle. Yeah. Coming up in the next hour, Lindsay Piegza of Stifel on the outlook for this Fed. We're only a week away, not even now. Greg Staples of DWS, we're going to talk about the bond market with him. Have we finally seen the highs of the year in this bond market in yield terms, 2s out to 10s? And James Athey of Aberdeen. James has got some things to say about Europe, I know, and on risk assets more generally, and he's perhaps in your camp, Lisa, more than Marko Klanovic is over at JP Morgan.
The two polarized.
Absolutely.
We'll hear from Mr. Athey a little bit later. Looking forward to it. Live from London, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. A retired federal court judge has been named as special master to review all 11,000 documents seized at Donald Trump's Florida home. The special master has until November 30th to complete the review. Meanwhile, the judge in the case has refused a government request to use documents with classified markings in a criminal investigation. The White House is offering state and local governments $1 billion over 4 years to fight cybercrime. It's part of an effort to beat back attacks from criminals who have targeted everything from gas pipelines to meat factories. The money comes from an infrastructure bill that was passed last year. Meanwhile, shares of Uber, they are lower today. The ride-hailing company has shut down internal Slack messaging while it investigates a cybersecurity breach. A hacker claims to have accessed sensitive company data. In Ukraine, President Volodymyr Zelensky says a mass grave has been found in a city that Russian troops abandoned last week. More information is expected today after a visit by journalists. Meanwhile, President Biden says the U.S. will give Ukraine as much as $600 million in additional weapons and ammunition. The aid will come from existing stockpiles. And as more companies make the return to office push, many employees feel they have no choice. According to a survey from productivity software company O/, almost 80% of remote workers think they would be fired if they said no. Nearly 60% of employers say they'd be okay with them resigning instead of returning to the office. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment, that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
You do not get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
The major problem that we're getting from the global economy is the inflation, but particularly the effect it has had on interest rates. It is very tough to fight that inflation, which you can say is a supply inflation rather than demand inflation. Central banks are good at managing demand inflation, but less so in managing supply inflation.
Jose Antonio Ocampo, the Minister of Finance and Public Credit for Colombia. Fantastic to catch up with him maybe about 30 minutes ago.
It is. And Joe, what's important here is he said it's not 1998. There's a lot of fear out there about the X crisis that as you mentioned this earlier this week, you can get a whisper of what happened in the past, but this is new, and the new part of it to me is coming off the pandemic. No one really expected this.
Struggling with these chairs. Need to shift over to Bramo just a little bit. Just turned away from her. You good?
I'm good.
Are
you good?
Okay,
great.
We're good. I can check it on the market now. Down about 1%. All is right in the world. On the S&P 500 for the leases of this world, we're down by 1.2% on the S&P. Come on. I know. I'm just joking. Okay, it's a joke. All right.
Don't make me.
We're traveling together. We're sharing a plane. It's going to be beautiful. All right. Yields up. A couple of basis points on a 10-year, 346.50. Equities a leg lower, Tom. I think it's fair to say. In the last 30 minutes, we're down 1.2% on the S&P. Yields a bit higher by a couple of basis points on 10s. Not a million miles away from 350 at 346.50.
We're going to get you into the market open in the next hour, and we're thrilled to be here with this last hour of the week in London. I will be here Monday for the funeral. That will be, of course, historic with the world leaders attending. Marcus Ashworth is noting that as well. He's Bloomberg opinion columnist and joins us here with a broader discussion of the moment we live in. Marcus, you and I have been through any number of crises like this. What is different this time besides that we're coming out of a pandemic?
Well, it's interesting. I was on radio earlier talking about 30-year anniversary of sterling falling out of the ERM, the exchange rate mechanism. This is a different crisis for sterling at the moment, that's for sure. Because it's a wider global crisis caused, well, by the strength of the dollar, which is starting to cause real pain. I mean, you were talking about FedEx earlier. That's right. a brief forecast of what's happening already hard in Europe and also in the UK. We have very bad retail sales data, a very volatile number, but the consumer has hit a brick wall hard in the UK, and we're probably, therefore, already in recession.
Right. Marcus, I want to channel Steve Rocha on this and his great work on asset dynamics away from monetary and fiscal policy. If we assume, unlike ERM 30 years ago, that we have a much more floating rate dynamic FX system and financial system, does that mean that given a crisis that we see more abrupt moves in asset prices?
Well, probably less, I would say. I mean, obviously going back to the Plaza Accord in 1985, and obviously the only real likelihood of currency intervention is going to happen in Japan. That's probably about the best news that sterling could have, because if anything can weaken the dollar, will benefit the euro, the yuan, the Korean won, pound sterling, the whole lot. You know, at the moment, it's just all about the dollar, and that makes it very hard. But it is least liquid, and it is at least liquid in the sense. What I worry about is with quantitative tightening and also too much interest rate hikes from the Fed, we start having a problem with dollar liquidity. That's the thing that saved us through the pandemic, saved us through the global financial crisis when they were able to pour it in. So open and free exchange rates are a great thing. It's painful, but it's not sharp pain when things collapse, like, for instance, when the Swiss National Bank all of a sudden took their peg away from the euro. That was real pain.
Well, Marcus, to that point, and you mentioned that Japan might actually do intervention to try to strengthen the Japanese yen. What are the consequences for the bond market globally if they do that? It's not so much the yen, it's the JGBs that might sell off at a time when there isn't that much liquidity.
Well, I mean, the Bank of Japan has got a lovely control on two things. It's controlled, you know, perhaps its interest rates and clearly its bond market. But it can't control the currency at the same time. So if it does come in and try and control the currency, it's going to have to sell U.S. reserves, e.g. U.S. Treasury bonds, which may make it a little harder for it, but the net effect for the bond market in the U.S. should be bad. Bear in mind that, you know, China and Japan have huge stores of U.S. Treasury bonds. If they start selling it for not, you know, for justifiable reasons to protect their currency, I'm talking Japan here, then that is going to have a knock-on effect also into the U.S. market as well. But clearly, I think currency intervention rarely works. The Japanese have had a very bad experience with it. They've learned really the only way to do it is when the tide turns back in their favor, then intervene and push that retreat much harder. But to try to draw a line in the sand and defend currencies, it really is a fool's game, I'm afraid.
What's your conviction level and the people who you talk to about peak yields on the longer end? We are hearing and seeing buying of the bonds when things start to get bad, but not necessarily with any real reliability. We are seeing yields once again tick upward for the 10-year. What's your sense of how close we are to peak longer-term yields?
Nowhere. I wish I could say with any conviction that anyone's saying this is. It's a great time to buy short end. Along, but I don't have any conviction, nor anyone I speak to, that the bond market rout is necessarily close to being over.
And Marcus Ashworth, Marcus, thank you. It's the only thing I have conviction about, that no one has any conviction over anything right now, Lisa.
About Marcus, or just in general?
I mean, Marcus is not, and I agree with him. We've had a 15% move on the dollar index this year.
You know, you put it really well earlier when you're saying that there was this feeling long ago, people would say yields are going to rise, and then they got sucked back into the reality of the low yield vortex. Are we putting that on opposite now? Is that where we are with yields, with rates that are poised to rise and inflation? It's the highest that it's been in decades.
We all remember it coming out of the financial crisis. It was forecast after forecast about higher rates next year, the year after, and it just never happened. It never materialized.
Well, and the inflation never materialized either, which is arguably why the Fed made the error that so many people thought that they made, where they waited too long, because inflation had already been deemed dead.
conditioned by the previous regime and sowing the seeds for the mess we're in right now, I guess, to some extent. Trying to work out now whether we have fully capitulated, Tom, on this idea that we can't live in a 3-4% Fed funds world. I don't think we have, because the moment I put out that Matt Lazzetti call over at Deutsche Bank, they're looking for something close to 5. Tons of pushback. Can't live with 6% mortgage rates. Can't live with 5% Fed funds. That's the overwhelming consensus.
We had a conversation earlier this morning, and a thought went through my head, John, the idea, and this is out there, I think it'll be in the weekend literature, where's the catharsis? And we're used to that. Where does VIX go 27 out to the fear of 32, 33? It just hasn't happened. Yes, we're down, but there's just a vector to it. There's just this impulse to it, unlike the down catharsis OMG feel.
Another leg lower. Right now, we're down about 1.3%, 1.26.
Like that professional analysis, OMG lower.
I love that.
Nailed it.
That was beautiful.
The OMG lower would actually maybe get a response. The fact that we're not getting it isn't getting a response.
I do agree with that.
It's just great to see you two agree with each other.
It's just
35 minutes out from the opening bell.
I'm going to swim the Thames this weekend.
Equity's down 1.3%.
We've got a face straight.
This is
I have my floaties on.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our target.
33 million people have been affected by this flooding in the monsoon.
Disruption is the whole point of a strike.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Make it very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close. Weekdays on Bloomberg. Politics, From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg. This is an extended edition of Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from London for our audience worldwide. Good morning, or good afternoon, good afternoon. This is Bloomberg Surveillance, and the countdown to the open kind of blended into one beautiful thing. With 30 minutes to go, equity futures heading lower and taking another leg lower in the last 30 minutes or so. We're down about 1%, plus 1%, down 1.3% on the S&P 500. With Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Futures down 1.4% now on the S&P. I can't keep up, TK. On the NASDAQ, we're down by 1.43. Well, that's the point.
The deterioration in the last 90 minutes has been exceptional. You're looking at SPX 3800, which people have written about, and we're all going, yeah, right, while we're here. And also, like Dow 10,000, I'm sorry, a Dow 29,000 handle is a moment from Dow 36,000.
He's going to weave that in.
TK doesn't mention the Dow the whole of this morning, and then you wait until the 9 hour.
Well, wait, because we're going into the market hour now, and we know that America looks at the Dow as they look at the VIX.
Let's look at FedEx. FedEx in the
VIX, FedEx, I like it.
FedEx getting hammered, Bramo. What are we down by? 20% through most of this morning?
Yeah, and just staying there because of this warning, and we've been talking about it all morning. You pointed out how the velocity of change in their business outlook was what caused them to downgrade their guidance. And how much is this going to be a story for others as well?
It's a story for Mike McKee as well. Mike, we're all trying to get some kind of read on the U.S. economy. FedEx not getting a great read on the global economy right now. Your take?
Well, they are supposed to be some sort of proxy for the global economy because they move the stuff that makes up the global economy. And so here's the quote that scared the heck out of global Wall Street. Raj Subramaniam, the CEO, saying in their earnings report, global volumes declined as macroeconomic trends significantly worsened. A warning flag for the economy. It's already been picked up by economists. We have just now a whole series of Bloomberg surveys from around the world about the probability of recession. You take a look at what they're thinking for the UK and for the Eurozone, 60%. Generally, recessions follow when you go to about 30%. The US is at 50%. So there is a general feeling that a global recession seems to be coming. And we're seeing that reflected not just FedEx, but in a lot of other companies over the last couple of days. We've got General Electric, McDonald's, Alcoa, Nucor, the steel companies and metal companies really concerned about demand falling off as well. And we're finally seeing all of this reflected in earnings estimates from analysts, which had hung in there much higher than people anticipated. Even as the stock market's been falling, that is starting to roll over. It is becoming acceptable to think a recession is on its way.
Mike McKee, what is the history of how any central bank, and particularly the American central bank, reacts to this upset?
Well, the Fed in the past had reacted to markets, and that gave rise to the whole Fed put idea. But this year, they're trying to discourage that very strongly, telling the markets, we are not going to get involved unless there's a systemic problem. And right now, you're able to sell your stocks and get your cash without a problem. So the Fed is going to stay sidelined, and they're going to look at this as maybe the wealth effect falls a little bit, and that slows the economy.
Mike McKee, thank you on the latest. The wealth effect, this market's been hammered this year. Now we've got to think about house prices and what's going to happen to them with 6% mortgage rates, Bramo. 6%.
Yeah. This is the reason why people have been so surprised that the consumer has hung in there, right? You'd think with the wealth effect of stocks being lower, of housing prices going stagnating and possibly going lower as well, would make a difference.
We're lower right now on the equity market. We're down 1.4% on the S&P, about 25 minutes to go, 26 minutes to go until the opening bout. Joining us now is Lindsay Piegza, Chief Economist at Stifel. Lindsay, I'll start with Deutsche Bank's call. They're considering, in fact, calling for a 4.9%, 5% Fed funds rate next year. Do you think that's achievable?
Well, it's certainly not out of the realm of possibilities. It's going to depend on how inflation behaves. The Fed has been very clear that they will continue to raise rates regardless of the cost to the underlying economy in order to get the bedrock of the economy, price stability, reinstated. So should we see prices remain at these elevated levels or worse, push higher from here, I do think the Fed could be poised to raise rates significantly above earlier expectations.
Lindsay, I want to understand the FedEx syndrome, if we can call it that, a little bit better. They're warning about the global macroeconomic issues causing their business to see a sharp decline. How much is that going to be the theme for other U.S. companies, that the U.S. cannot escape the fate of the rest of the world? The rest of the world is deteriorating a lot faster, and there will be that rebound effect onto the balance sheet.
Well, we are a globally integrated economy. And so if we do see overseas demand, overseas production stalled, that's going to have not just an implication for economic activity here, but a significantly negative implication for economic activity here. We've already seen how supply chain disruptions can deteriorate production here at home. You compound that with a loss of overseas demand, and that will just snowball, have a snowball effect for U.S. businesses. But what we're seeing in the domestic economy is already a loss of domestic consumption. So it's not just about what's happening overseas. We have plenty of pain that's being felt right here at home.
We've been talking a lot about how the Fed is looking at lagging indicators to determine their policy. Do you think that the slowdown that we're seeing, that the impact that we're seeing, as you say, is sufficient to give the Fed confidence, to give people confidence that inflation is decelerating quickly enough? The Fed doesn't have to necessarily be as aggressive as they're currently making out.
I don't think we've seen enough evidence in the price data to suggest that inflation is coming down in a meaningful way. Now, I do think there's enough evidence on the consumer side, on the manufacturing side, on the broader-based growth side to suggest that the economy is slowing. But that's not going to be enough to ensure that price stability returns. Remember, we're dealing with both the demand and the supply side of inflation. So while the Fed raising borrowing costs will result in a tap down of investment, a tap down in demand, that can control the demand side of inflation. But raising borrowing costs will do nothing to alleviate the supply side inflationary pressures. So the Fed is going to err on the side of caution, waiting longer, raising rates higher than they normally would in other historical cycles because of that complicated composition of inflation.
Lindsay, if the markets deteriorate into this Friday afternoon and Monday and Tuesday, whatever comes, is it enough to change the Fed call on Wednesday?
If it's enough to change market expectations for the Fed move on Wednesday. So if investors begin to move back into a more benign 50 basis point camp, I do think the Fed could be willing to capitulate to market expectations. But right now, as it stands, the market is fully pricing in a 75 basis point increase. And in fact, some investors are still considering a larger 100 basis point increase. So at this point, I think 75 is baked in the cake.
Okay, fine. But are you suggesting that if we see this kind of market drop that we're seeing right now, that we could just automatically move a Fed to 50 beeps?
Absolutely. And we've seen this happen before. Prior to the July meeting, the June meeting, the Fed is watching what the market is anticipating, waiting for that green light for that larger 75 basis point increase. So if the green light is there, the Fed will move. Well, Lindsay, if investors start to get weary, I do think the Fed would slow that increase.
Lindsay, the broad yield curve, 230s, is back 22 years. Isn't that enough to suggest to them 50 and not 75?
Suggest to who? The market or the Fed? Because the Fed, again, is the Fed is focused on prices. The Fed is not focused on market metrics. The Fed has blinders on right now, and price stability, they said, is the primary focus. So as long as markets, despite the apparent inversion of the curve, the dysfunction is not there in terms of market activity, and that's not enough to derail the Fed's focus from ensuring price stability. Remember, we have inflation at a 4-decade high. And so even with that second derivative improvement, that price ascension slowing moderately for 2 consecutive months, that's not enough to breach that threshold that the Fed has said is needed to begin to pull back away from this more aggressive pathway.
Tom, if they don't deliver what's priced, that's going to result in an easing of financial conditions.
Yeah, I guess, sure.
I don't think
I get it.
that's what they want right now, Lindsay, and that's the difficulty. And that's why some people still doubt their guidance, Lindsay, because they don't think they're going to say certain things out loud. For instance, really unveil what the threshold is for them to back away from interest rate hikes. Can you give us an idea on what you think that threshold is for them to take a pause?
I think we need to see a meaningful retreat. So we need to see headline inflation come back near this 6 to 7% range. I think that would be enough to suggest that we are seeing this retreat, that there's a downward momentum in prices, and that would be enough for the Fed to be willing to back off for more benignly sized rate increases. It wouldn't be enough to force the Fed to pause, but I do think that would be enough to get back into the range of a 25, 50 basis point clip. But it's not until we get down nearer 4% that I think the Fed would be comfortable to pause rate increases at that point to allow inflation to continue to retreat further to that 2% preferred target range. So there's still quite a ways for the Fed to go.
We've got to run. It's great to catch up with you. Thank you, Lindsay. Lindsay Piesa there of Stifel. Your equity market right now, another leg lower in the last 30 minutes or so. We're down 1.4% on the S&P 500, a kick higher at the front end of the yield curve. Your 2-year, Lisa, is back through 390 this morning.
You know, what Lindsay was saying there, that right now they are not looking at what the market is doing. There is not market dysfunction that they have to keep track of, like that capitulation, Tom, that you were talking about. So what they are looking at squarely is the price action. It is not getting lower. They're not seeing inflation come down, and that is the reason why the CPI report was a real pivot for the market and not in the right direction if you want to be long risk assets.
It wasn't like the end of 2018, or for that matter, during the pandemic, where you could actually identify things that felt disorderly,
right?
Particularly in the pandemic. And late in 2018, you had the whole primary market totally freeze up in the high yield market. We're talking about a justified change in price right now, not disorderly price action, at least not yet in the major parts of the market.
Justified by what's going on with inflation, but interesting that you note the credit markets. The fact that we haven't seen disruption there raises this bar even higher for the Fed to intervene or the Fed to take a pause, because you are still able to raise money, even if it is at a higher cost.
We joked a few times over the last week as to whether Chairman Powell just needs to reread the Jackson Hole speech, Tom, in the news conference next week. Do you think the market's finally getting the message after flirting with maybe a pivot just 2 weeks after it for a moment in time?
Why would he not read that speech? Because of the international tea leaves that are out there. I take your point completely. Domestically, the stock market, full faith and credit, the spread world that Lisa follows, international has shifted this week.
Do you think it's starting to bite, Tom, in a way that feeds back into the Fed story
it will affect
that makes them
his
take
dialogue.
attention?
They're going to say forever they're not focused on it. Absolute baloney. Philippine peso pushing through 58.60 would be a crisis for that nation, just as one example. And there's 15 Philippines out there right now, including Colombia.
Okay. At the same time, they want to get inflation lower. A strong dollar helps them achieve that. So what's the incentive domestically for them to do that? I mean, they're not central banker to the world, even if the rest of the world views them that way.
It's everyone else's problem,
exactly.
At least for now, and it's not the Fed's problem yet. It may well become their problem soon. I think the Bank of England, just around the corner from here, is a perfect example of a bank that's got to grapple with this.
Exactly.
Sterling at 113. Guy said it earlier, importing inflation. It's problematic.
I saw Governor Bailey coming out of Greg's.
What did he say?
He was too busy chewing on his sausage.
How many sausage rolls have you had?
I've had a few.
Where was he supposed to go when he stomped out of the other restaurant?
I recognized me, turned around and walked away.
If you are just tuning in, Tom did storm out of breakfast this morning, and as is my day job, it was my role to try and, smooth things out with the hotel.
What are the biggest challenges for General Dynamics, and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. The top names at the Fed are on Bloomberg.
It is essential we get inflation down. People want jobs, but they also want low and stable inflation. We have to give them both.
Nobody covers the Fed like Bloomberg, your global business authority. Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg. Are on the Fed.
The Fed has more work to do.
75 basis points seems to be baked in.
How quickly do they get to the terminal rate?
How long do they hold them there?
Chairman Powell's going to have to read the same speech twice.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Is the consumer buoyant?
The dollar is a great place to hide.
The U.S. are going to overdo it.
Investors just have to hold on to their hats.
With special commentary from former Fed Vice Chair Richard Clarida. Bloomberg Surveillance. The Fed Decides. Wednesday on Bloomberg, your global business authority.
They are feeling their way to how far they have to raise the federal funds rate. They want to be restrictive. They want aggregate demand to slow down a lot so that that underlying inflationary pressure starts to ebb. But what they don't want to do is intentionally cause a recession. And getting to that point, I think, will require a bit of luck.
That was Morgan Stanley's Seth Carpenter on with us just moments ago. Bloomberg's Ira Jersey joins us right now from Princeton for more on this bond market. Ira, through 390 on a 2-year. As you reset and consider where this is going next, what are you thinking?
Yeah, it keeps going higher, and I think that as we start to reprice the Fed for some potential of a terminal rate that's above 4.5%, I think that 2-year notes at this point can keep going. I mean, we thought that we would be somewhere near here at the end of this year, so we've just gotten to these all of these levels much faster than we thought, and I think part of that is just the persistence of inflation and the insistence that the Federal Reserve has that they're going to keep on fighting inflation for now.
3 months ago, Ira, that would have been a revolutionary call, 4.5% of a Fed funds rate, but that is currently what's being priced into the market. How long can the Federal Reserve hold interest rates at that type of level, let alone even get there, before you do get some sort of big deterioration or market event?
Well, thanks. That actually was our call back in June, so I appreciate the fact that you said that was revolutionary. Back then. Our call has been that we would reach there in January or March of next year, and then I think at that point the Fed holds there for at least 6 months. Now, 6 months is not atypical, right? So if the Fed gets to the terminal rate, usually there's about a 6-month lag before they start to cut interest rates. But so much of that will depend on the path of inflation over that period of time, right? If inflation comes down much faster than we think, and core inflation measures in particular start to come down, unemployment rate starts to go up, those are the things that might cause the Federal Reserve to follow the market's current path and start to cut in the second half of 2023. But if it doesn't, if the economy holds up a little bit and that kind of the swoon that's going on now is more of a mid-cycle correction, which is what I think it is, then the Fed can hold there maybe for 9 to 12 months before it starts to cut interest rates.
I'm not asking this in a snide way. Are people losing money now? Is it like ugly in bond world now with price down, or is it being managed?
Well, a little bit of both. I think one of the reasons why you've seen some of these large moves is people are getting short, right? You look at futures positioning, and just about everyone who can be short is short. Now, obviously in futures you have to have an equal number of buyers and sellers. But if you look at the repo market and what's gone on in some of the funding markets, where you need to, just from a structural perspective, that's where all the hedging goes on. It seems like a lot of people are short, and that's one of the reasons why I think you've seen these major pullbacks when you get somewhat better data from an inflationary perspective. You just see the market bouncing around so much, because it is hard to be short the market, because the problem is being short right now means that you're paying 3+%, almost 4%, if you're short a 2-year note, because if you're short a bond you have to pay the coupon. So it's just hard to be short for a long period of time.
Ira, thank you. It's good to catch up. And what a call that was, by the way, on the 2-year earlier this year, because hardly anyone was calling that. Right. Greg Stables is joining us now, the head of North America Fixed Income at DWS. Greg, I asked this to you a few weeks ago, so let's do it again. Have we seen the highs of the year on these yields yet?
We haven't seen the highs, I think, in the 10-year Treasury. I don't think we've seen the lows in the Euro. I think we're going to go through 3.5% fairly soon. There's a lot of buying that's waiting to get to 3.5% 10-year, so we could bounce around a little bit here, but I think looking what's going on in the 2-year, it's going to pull longer rates up eventually as well.
What's the high for the 2-year? When do you start to get confident that perhaps we've gotten full hawkishness priced in?
There's a bit of an upward gravity pull, if you will, in terms of the expectation of the terminal Fed funds rate, and obviously we've seen that reprice just over the past week or two. 4.5% seems to be the number right now. As you know, Matt Lozzetti, a colleague of mine, is talking about potentially 5%, and as long as that number is going up, it's going to pull the 2-year up with it. 4% is certainly not beyond the pale, and perhaps even as much as 4.25% before we finish this cycle.
How does credit respond to this, Greg? Does issuance go on hold?
We've seen a fair amount of issuance already. I'll tell you, I think there may be some acceleration from market participants to try and issue within the marketplace. It's a concern that if they wait a little bit longer, they face both higher coupons, higher funding rates, and the possibility that the window shuts overall. I know one thing that we've been talking about on this program and elsewhere is our concern about evaporating liquidity overall in the marketplace. It's a function of, we were talking about earlier, the idea that regulatory capital is making the funding markets dry up a little bit, as well as the pernicious effect of QT. I mean, nobody quite knows when this now $95 billion a month runoff from the Fed's balance sheet actually starts to impact liquidity, but we're starting to see it already in terms of the ability to find bids within the marketplace. Bid-offer spreads are widening in the Treasury market. It's not too concerning yet, but you don't want to wait until you need to find funding and then find out that it's not there.
What's the easiest way to measure liquidity in the market for mere mortals?
From our perspective as real money fixed income investors, it's our ability to find bids within the marketplace for the not go-go bonds. We're talking about the bottom half of the S&P 500, if you will, the triple Bs, those issuances of maybe a $500 million outstanding, and you go to market and expect to get a decent bid from 2 or 3 dealers, and you're finding your marks a point or two below what you had it marked at just because the dealers don't want to step up. Again, we're not quite there yet, but it's starting to get a little bit concerning.
Greg, can we just pick up on a theme that Lisa's been pushing, including in this conversation as well on QT? Where is it? Where's the balance sheet reduction, Greg?
You know, it's tough to say. We're looking at the mortgage market in particular, where the Fed has indicated that they don't really want to hold mortgages overall in their portfolio long term. They'd like to run that off. There's a lot of concern within the mortgage market if they accelerate that runoff by selling lower coupon mortgages. The Fed owns a material part of the 2 and 2.5% coupon mortgages that were issued over the past 2 years, and those aren't disappearing anytime fast because prepayments are so slow. So do they start accelerating outright sales with that and disrupt that market overall? I think they're concerned about raising mortgage rates much higher than they are right now. And broadly, QT, it's a ways away before it truly impacts. I think banks are happy to see their balance sheets reduced right now. It eases some of the pressures from the SLR, the supplementary leverage ratio, so it's probably going to come out of Fed repo. But ultimately, I think it just means a lower level of liquidity overall in the marketplace. It's the reverse of what they did for 2 years when they were pushing money into the marketplace through quantitative easing.
Hey, Greg, thank you. Greg Staples there of DWS. 5 minutes away from the opening bout with equity futures lower, yields higher on a 2-year through 390, on a 30-year up 6 basis points at 352. And equities down by what, 1.3%? Down by 1.4%? That's where we are, Tom.
John, I'm focused. I mean, I'm looking at the train. I've never gone as far out as zone 3. Like if I take the train from London Bridge out to Tottenham,
you're getting on the
like
underground.
Where
are you going?
There's a game, or there's like
they're
playing Lister. The Tots are playing Lister.
Okay.
I guess.
Cool. When's that happening?
This weekend, I think. Are they going to have matches?
Oh, you're going to a game. Nice.
I'm considering it.
The opening bout, just around the corner.
Yeah.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
We were thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our target.
33 million people have been affected by this flooding in the monsoon.
Disruption is the whole point of a strike.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Seconds away from the opening bell in New York City. The opening bell just about to ring, with futures lower by 1.15% on the S&P. On the Nasdaq 100, we're down by 1.16. On the Russell, we're down by 1.2%. Call it negative 1.1. In the bond market, yields a whole lot higher through most of this morning. On a 10-year, on a 2-year, on a 2-year, through 390. On a 10-year, approaching 350, up a couple of basis points to 347. Dollar a whole lot stronger against pound sterling. Earlier 113 on cable. Right now on euro dollar, 99.67 on that currency pair, negative 0.33%. With some moves around the opening bell, let's get to Abby for more. Hey, Abby.
Hey, John. Well, this sort of sell-off that we're seeing for futures, that's what happens when you have FedEx having its worst day since November of 1980. Back then, the stock dropped 47%, but right now down 22%, of course, on that bearish pre-announcement, also pulling the guidance, volumes declining on macroeconomic worsening, Asia, Europe, areas of weakness there. This, of course, is reaffirming the idea that a global recession, a global slowdown is here or very soon. And it's confirmed by the idea that GE, they also recently pre-announced to the downside for their third quarter at least. Now they're talking about the supply chain, but to have another conglomerate, or to have that conglomerate also pre-announcing, plus McDonald's, Alcoa, and it's also worth noting GE, their big business is aviation. So if FedEx is seeing such weakness, it could pull on GE's business going forward. Now these pre-announcements also weighing on UPS and Amazon, that e-com giant, falling as well. And just worth noting, John, of course, that you've had lots of big names recently joining Mike Wilson over at Morgan Stanley in terms of the bearish call, the likelihood that the S&P 500 drops 20% from here, including Ray Dalio and Jeffrey Gundlach. Goldman also talking about bearishness. It seems to be here, the confirmation from the global economy, these signs that we really are seeing this slowing.
Abby, thank you. That drop on FedEx down 22%. Lisa, the biggest one-day drop potentially going back to what, 1980?
Yeah, and the $11 billion of market cap, just to put it into perspective at a time when a lot of people are wondering who's next.
FedEx down and down hard. Sticking with big tech, I want to turn to them right now. Equities down, yields up, tech getting hammered. Ed Ludlow joins us now from New York for more. Hey, Ed.
Yeah, good morning, John. Down 1.5% on the Nasdaq 100, coinciding with that stronger dollar, but also the push higher in yields. This chart actually showing the relationship between the Nasdaq 100 and real yields, but of course, you and I both tracking the movement on the 2-year and the policy-sensitive end of the curve. There seems to be a real relationship there with tech throughout the week. What I find interesting is the breadth of the sell-off in tech shares. It's not just the speculative corners of the market, but the mega caps as well. You look at names like Microsoft and Google, often considered defensive holdings, right, because of the strength of their balance sheets, their entrenched competitive positions. Year to date down, though, we're down collectively $3.2 trillion worth of market cap. You also think about the likes of Amazon, of course, impacted by the news overnight with FedEx because they are suffering the same cost pressures, but now there's the concern about the suffering consumer. And with that inflation print we got earlier in the week, we're moving past the inflation discussion towards the narrative for higher rates, not just because they discount the present value of future profits, but what does it mean for households, right? And the accumulation of debt, because iPhones are expensive these days, John, and it's interesting to continue every day seeing these mega caps decline with the rest of the technology sector.
I think, John, what's so important here is you look at the tech analysis, and it's about growth of revenue. Is it going to be the only place with actual revenue growth on a relative basis? How does everybody else do from tech?
As it was in the pandemic.
Yeah.
But very, very different situation
Different
compared to
now,
where we
but
are.
I would really watch off tech.
Equity's getting hurt here. We're down by 1.3% on the Nasdaq 100. James Athey joins us, investment director at Aberdeen. James, let's start here with something Michael Harnett over at Bank of America, what he said this morning. He said that yields make new highs. That means stocks have to make new lows. Do you agree?
Yeah, on the yields front, I mean, I've been a little bit wrong. I thought once we'd had that blow of top to 350 in 10-year, we probably had seen the highs for the year, and we're perilously close to making new highs, you know, right this second. So it feels a braver call to say, yeah, we're absolutely done. We are leaning against this level because we do think that the tightness of monetary policy that's that's coming down the pipe really is going to hit economies like a sledgehammer, and that should just continue to invert the curve. So we're happy to lean in, but I certainly agree with the idea that higher yields reflecting tighter monetary policy at a time where consumers are battling with negative real income growth should be a cold shower for the equity market, and it is a cold shower for the equity market. With respect to big tech, just quickly, a good company at a bad price is a bad investment. I think that we're seeing some of that coming out now.
Someone at Goldman might be getting a cold shower right now. Sri Natarajan has the story. Hey, Sri, walk us through it.
Well, we've all been talking about the Goldman consumer unit expansion and how it has grown over the last few years, but this 6-year-old venture is now facing scrutiny from the Federal Reserve. Our sources tell us that officials at the Fed have been conducting a review of the business over the last few weeks, and it is very much ongoing. There is no indication of any wrongdoing, but it certainly goes beyond their regular business of oversight and is also distinct from what they sometimes do, which is industry-wide dive into various business areas of interest. This is a very specific look at Goldman and its consumer unit, and it adds another headache for their CEO, David Solomon.
Sri, what is the difference between an SEC review and a Federal Reserve review?
To be very clear, from what we understand right now, this is part of their regular oversight. Fed oversees Goldman Sachs. They're always in conversations with them. But this goes beyond that, where they are drilling into this business and making sure that the business and its managers and leaders have complete control over what is going on. Since the business is still losing money, it was supposed to break even this year. That has pushed out. It has lost more than $4 billion since inception. This year, they're set for record losses, and that could perhaps explain some of the heightened interest from the Fed in this case.
So just elaborate a little bit more, the heightened interest in terms of stability or heightened interest in terms of something else having to do with this unit?
I think it's fair to say when you have a firm like Goldman that really has no real history with the consumer market, it is a storied Wall Street firm. It has dealt in the world of high finance with hedge funds and corporations and governments, but never really with consumer. It has grown rapidly in that space. By 2024, it hopes to have $4 billion in revenue. That is pretty incredible growth. At the same time, I think regulators would want to make sure that they're doing it in the right fashion and in the right manner. And the fact that they've already missed their own targets in terms of breaking even and profitability, that is something that would pique the curiosity of regulators.
Sri, how much support does leadership at this bank have from shareholders?
One way to look at it, this year the stock's down about 13%, middle of the pack, since CEO David Solomon took over on October 1, 2018. The stock's not really done much to close the gap between, say, the likes of JP Morgan and Morgan Stanley. Price to book, it is still exactly where it was 4 years ago. That's not a good picture, especially when you have a competitor and an arch rival like Morgan Stanley doing much better. At the same time, in a year when you're expecting earnings to fall roughly 40% from the boom times of last year, you will have other parts of the division and other senior leaders at the firm irritated that there is another large unit that is soaking up cash, which is likely going to lead to less compensation for a lot of folks and even layoffs down the road in the next few months at Goldman Sachs. That's going to lead to increased grumbling.
Hey, Sri, thank you. Great work by you. Fantastic reporting. Sri Natarajan there of Bloomberg. The stock, Lisa, on Goldman, we're down about 3%.
Yeah, and this comes in tandem of both this story that Sri Natarajan reported for Bloomberg, but also just this concern about banks and what the future holds at a time when the yield curve is inverting and consumers are spending less and fewer deals.
James Athey's still with us, investment director at Aberdeen. James, banks have finally got what they wanted, higher rates, and seemingly it's still not helping banks, and that's true of Europe, and it's true of Wall Street as well. What are your thoughts on that sector now, after Citi earlier this morning went underweight the financials?
Yeah, I mean, high rates in and of themselves, I guess, really don't solve the problem, right? I mean, just at a very basic level, banks are in the business of maturity transformation, so they borrow short and lend long. So the gap between short and long rates should be directly, related to their profitability. So an incredibly flat yield curve means that they're having to borrow money at quite high rates and not able to lend it at much higher rates, or even lend it at rates which are lower. So that it's not surprising to me that higher rates but a flatter curve has not been a fantastic period for banks. But realistically, these are incredibly complicated institutions that are now regulated in an incredibly complex fashion. And you just mentioned it there in terms of reporting the delta versus last year, that bar was particularly high for a lot of sort of corporate activity last year. So headwinds in markets, headwinds in banking, and headwinds in sort of advisory and IB. It's not too surprising to me that they're pretty unloved at the minute.
The story that Bloomberg reported about Goldman Sachs had to do with the consumer-facing unit, and I'm not going to get into the investigation aspect of this. I'll wait for more details to come out. But, James, there is a question about the health of the consumer and whether that's adequately been priced into some of the consumer-facing equities that we've already seen get beaten up quite significantly. Is it enough?
Short answer, no. I think, again, looking at that move in FedEx, that's not particularly normal, and it looks like a cold shower moment. Markets seem incredibly reluctant to be too forward-looking when the future doesn't look particularly rosy, and so I think it's a show me the money kind of market, and so we see when certain results don't come out in accordance with expectations, and particularly when guidance is weak or guidance is removed altogether, then you suddenly just get this abandonment of the ship and you get these massive drops. But broadly speaking, looking across the entire market, looking at some of the more cyclical sectors like discretionary consumer, they still look to be expecting earnings growth. In a lot of cases, they're even expecting margins growth, and we're still attaching really quite average PEs to a lot of these stocks as well. And it feels like all three of those are downside risks for most of the equity market.
James, with Aberdeen, you are quoted on a daily basis across all of the British financial press. I have to ask your thoughts on what this government can do for growth. Can this chancellor deliver a growth mandate for the United Kingdom?
In the very short term, Tom, I think it's a really difficult situation. I think I can understand from a slightly cynical perspective why the Prime Minister is talking about the energy policy that she is, partly because it will mechanically keep inflation capped, and that should keep the Bank of England more on the sidelines. But it's a very blanket approach, and therefore you're giving money to those that really aren't in need of it. I think something that's more distributionary would be more appropriate and would take away some of those upside inflation risks. But where we've come from over the last 4 or 5 years, including the pandemic, to where we are now, has left government finances in a far from healthy state. And in the UK in particular, the expansion in the current account deficit at a time where sterling is falling and gilt yields are rising is a really risky combination for a government to be sort of priming the fiscal pumps. Ultimately, my answer is always, in these situations, we've been relying too much on cyclical short-term demand management. We've been relying far too little on long-term productive structural investment and enhancements. And I think at some stage we're going to have to wear a lot of short-term pain in order to get ourselves into a position where we can start to look more medium-term, more long-term. Hopefully this is the government to do just that, but the next 12 months are going to be incredibly difficult just given the economics.
James Athey of Aberdeen is going to be sticking with us. Lisa, that's what everyone's grappling with. How much pain do we have to go through? I'll go back to something we've discussed on this programme multiple times today and multiple times over the last few months. What's the price we have to pay to get inflation back down? What are these central banks willing to tolerate? Now, they keep forecasting an inflation rate that comes down, an unemployment rate that climbs. The Bank of England's got a recession baked in. When you start to realise those kind of data points, what do people start to say back to them? And I'm in the politicians too.
Yeah, but it's also so much that's unknowable at a time when what happens, for example, with zero COVID, with China, what happens with oil prices, what happens with some of the supply chain disruptions. There's so many exogenous potential risks. How do you game that out?
John, these markets are original. There's a little bit of good in the equity market. The 2-year, 392.
Something else, isn't it?
And we are now out on 2s10s to a 40-something. And I just can't say enough about the speed of movement here in the real yield.
13 minutes into the session, equities lower by 1.4% on the S&P. Live from London, this is Bloomberg.
that are capturing most of your time and attention?
Well, we have a unique way that we look at big new investments, and I'm not sure it's right or wrong. It just happens to be our way. And we ask ourselves when we're considering something 4 questions. We ask, if it's successful, can it be big and move the needle at Amazon? Is it being well served today? Do we have a differentiated approach? And do we have competence there? And if not, can we acquire quickly? If we like the answer to those questions, we'll go pursue it with a single-threaded team that isn't distracted by the rest of the business.
When it comes to the stock, it has fallen significantly. Do you think investors are missing something, or has tech just been overvalued?
I have never tried to predict what the stock's going to do. And any time I've tried to a little bit, I've been wrong. I do really believe that in the short term, the stock market tends to be a voting machine. In the long term, it tends to be a weighing machine. We have a concept we talk about a lot at Amazon, inputs and outputs, and the ultimate output for a company is share price, and then other big outputs are free cash flow or profit or revenue. You can't really manage the outputs. You have to manage at the input level, and that's where we spend all our time. And so if you do the right things for the business long term, things tend to work out. I think we've had very good returns for investors, and I expect that to be true again.
Most of us don't spend much time thinking about the grid, the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We're seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg. Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
Supportive of the idea of an oil price cap in general for Russian oil. We are working on amending the sanctions package that is required for this new proposal, and we know that we have to be fast on that one, and of course sanctions always need unanimity.
European gas fluctuating as investors weigh the impact of EU intervention. The packages are building up. Will Kennedy joins us now for more. Will, Italy the latest. Walk us through how big this one's going to be.
It's going to be quite big, John. The price cap that Ursula von der Leyen is discussing there is controversial, but it's interesting that she says that she wants to take part because the US is pushing this very hard, and it is potentially significant, but it's still unclear how this is going to work, and importantly, whether those people who are buying Russian crude are going to participate.
Well, I'm absolutely confused on this. In my week in London here, and into next week as well, I'm absolutely baffled about where the United States of America fits into this. Europe just seems so lonely in this war, in this energy production. What can the United States do to help Italy, to help Brussels, or for that matter, to help the best team in the continent, Norway?
Well, I think the US has helped Europe. They're exporting record amounts of gas and oil, actually, across the Atlantic, but there are the limits of what they can do, especially on the gas side. The US is a huge gas producer, as you know, Tom, but they are limited in gas liquefaction capacity that puts that gas into tankers so it can be shipped across the Atlantic, as much as possible is going. So there's not much more they can do here. When it comes to the oil side, I think what the US is trying to do with this price cap is find a way to hurt Russia by depressing the price that they get, but while keeping oil flowing so that the global price doesn't get too high. Now, there's a lot of skepticism about how well that can work, but the intent is interesting, not to limit supply and force the price up, but to limit the financial gains to Russia from selling oil.
Well, Kennedy, thank you so much. And I do wonder how much, John, we're going to end up with a Germany-like situation where nationalizing energy companies is going to start to be the conversation to try to get away from some of the punitive valuations that we've been seeing.
We spoke to Jordan Rochester about this, I think it was yesterday. Yes. My mind's a little bit blurred now. It's about when does it become real? Do you remember when Italy shut down over the weekend for the pandemic? And it was like that was the moment that it became real for the whole of Europe and perhaps for the United States as well. Is that moment in Germany? What does that look like for Europe later this winter?
Which is a question of when does it become realistic for markets? And James Athey, I wonder from your perspective, he's back with us, investment director at Aberdeen, and how much do we get a reality check going into winter about the crisis that everyone's talking about and seems to recognize, in theory, at least out there in policy land?
It's difficult, isn't it? There's a lot of moving parts. You know, we've gone from being epidemiologists to now being meteorologists to try and invest in government bond and FX markets, and I guess to some degree equity markets. Whether we have a mild winter, a quote-unquote normal-looking winter, or a harsh winter is going to obviously have a huge impact on energy demand in general. The extent to which moral suasion is successful in sort of capping or reducing energy usage just in general will also play a part. And obviously central bank policy and what that means for borrowing rates, for mortgage rates, for consumer confidence, that's all going to play a part too. I struggle to see really a huge upside in terms of the economic outlook, but whether or not we get to some of the really nasty tail outcomes does depend. You know, Scholz has been out today speaking and saying that, in his opinion, the gas inventories, gas storage that they've got will see them through the winter. If that proves to be correct, I'm sure that would be an upside surprise for markets.
I'm just wondering how much of this economic weakness so many people are anticipating, James, is actually priced. FedEx is getting hammered this morning. That's some indication that people weren't priced for a big slowdown in the global economy. I think that's fair to say, James. So I do wonder what other parts of the market are also not priced for a big slowdown in the global economy.
Yeah, I mean, just at some very simple metrics, the US yield curve 2s10s is inverted by somewhere between 30 and 50 basis points. Most of the other yield curves are still positive in that space. Your European yield curve, looking at Germany, you get some of the collateral shortage going on, but even in swaps, it's much steeper than the US, suggesting that the outlook is brighter for Europe relative to the US at a time where actually the amount of tightening that we're pricing is very similar between the two. I don't think that's right at all. I think that's a very rosy outlook for Europe. Going into the equity market, I mean, man alive, that place really does wait until the very last minute, and it's been dangled over the cliff before it wakes up. And we saw this in 2007 and 8, where equities were almost rallying right up until the cliff edge.
James Anthony, the direction and the magnitude of the move in fairly short-term paper, two-year U.S., two-year German, does it change policy over the weekend, into next week? Are those the kind of brutal moves that can change institutional policy?
But you know what? I mean, I think in most cases it's by design, and to a large degree, I kind of agree. Central banks have, kept policy way too easy for way too long. No surprise there. They've been doing that for 10 or more years. But this time, government policy was pushing in the same direction. We've got this massive inflation, and central banks were sleeping through that. Now they're rushing to catch up. But I think the rushing to catch up is the least worst option. I think it is the best option on the table for them. And in order to have that policy propagating through markets, but more importantly through the economy, and to slow demand, they need to see some of these reactions that we're seeing, where front-end yields really rise quite precipitously in a short space of time. Remember, there is a shock element to this, and of course markets are shocked, but from an economic perspective, it matters as much really how long we spend at these rates, because there's lots of debt that needs to be rolled over. There are lots of ways in which consumers and corporates can cope with high rates for a short period of time, but it becomes a much bigger drag on growth the longer it goes on. I don't think any of the central banks concerned are going to be looking at front ends at the moment and thinking, oh, this is a bad thing. I think they're actually going to pat themselves on the back and say, a job well done. What happens in 6 months, by the way, is a different ballgame. I think the Fed's comm strategy recently has been spot on. They're talking as if, they're Margaret Thatcher. This Fed is not for turning. But they have to say that because otherwise the communication becomes the policy. The market eases for them today, and they never get to that position where they can ease off. So they have to talk tough today. Hey, ask me again in 6 months when unemployment is 5 and the economy is shrinking by 2% every quarter. I think it's going to look a very different landscape.
Let's talk before then, James. That's too long. James Athey of Aberdeen. Thank you, buddy. It's good to catch up. 25 minutes in, we're down hard, off by 1.5% on the S&P 500, even lower on the NASDAQ and the Russell. The Russell had a few people talking up the small caps. The small caps don't look good today.
No, because they are going to necessarily be penalized with the same outlook that FedEx was talking about, people saying that U.S. momentum would escape some of the problems from overseas. FedEx casting a little bit of cold water on
Operation Get to Heathrow for you and I now.
Exactly.
Hey, you and me, we're going to head to Heathrow. Tom, going to leave you behind.
It's going to be something. We will have coverage of the funeral on Monday. Anna Edwards leading our coverage. I think it will be really something that really, for me, harkens back to 1963 and JFK.
Looking forward to your coverage, Tom, after the weekend. To all of you worldwide, thank you for being with us. Thank you for the team for putting together this wonderful studio for us this week. And thank you, London, for having us live from London with your market down 1.5%. This is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
Watch Bloomberg Surveillance Early Edition for the news you need when you need it.
I'm Matt Miller with Kayleigh Lyons in New York and Anna Edwards in London.
I'm going to be watching retail earnings from both Home Depot and Walmart.
Then surveillance for in-depth analysis.
Alongside Tom Keene and Lisa Brambitz, I'm Jonathan Ferro.
Across the board, these are good numbers.
And the big headline there is reaffirming the outlook.
How much does this give faith that you can get some sort of resurgence in consumer spending?
Bloomberg Surveillance. Be informed. Be prepared. Be ahead of the game. Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in five stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war. So the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Benegold as an opportunity to leave that troubled home. Benegold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Benegold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via that text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environments, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
Kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people want to unpack that. And so my audience is a lot of them are younger investors who are looking to hone their skills.
Tech in right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just attacked that video and were like, you explain things so much better than my boyfriend or my professor, or I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly, this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwit, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, The hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350. Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.